this is not just a solid labor market, it's a strong labor market late in the cycle.
This is not as tight of a Fed as the market, or really as the Fed thinks it is.
It's a labor market that looks okay, and probably 50 basis points is off the table.
It doesn't feel like monetary policy needs to be acting at a fast pace. We expect it to be more gradual.
The economy is okay, and there's not any forcing issue here to cut rates.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Monday on a 4-week winning streak on the S&P 500 following a blowout payrolls report on Friday. Your scores look like this. Equity futures on the S&P down 0.5%. On a Russell, some underperformance, were down by 0.7. On the bond board, a brand new look to the bond market in America. The 2-year through 4% earlier in the session for the first time since August, 398.89. The 2-year seeing its biggest 1-week pop last week, going all the way back to June 2022. There's been some changes to some calls already. JP Morgan, Bank of America dropping their call for a 50 basis point rate cut in November. Yardeni on this program a little bit later saying this Fed is done for 2024.
You have to think about what Mark Rowan, Jonathan, said to you before this jobs report. Looking at where financial conditions are, looking where real estate is, he called it a very expensive insurance cut. And now what you see in the market, if you look at the Fed funds futures, everyone that was pricing in 50, that is basically a 90-degree drop. And that is why CPI this week is so important. Mohamed El-Erian, after that report, said to you, inflation is not dead.
And all of a sudden, inflation later this week becomes that more and more important. Let's look at the week ahead. We've got CPI later this week coming on Thursday. Fed minutes coming on Wednesday. Some bank earnings at the back end of the week that we'll talk about a little bit later. JP Morgan and Wells Fargo. But that much more important, CPI on Thursday.
You'd have to imagine that for the Fed, the jobs report marginally shifts them away from the fear of recession and gently towards inflation. For the market, though, it's not a gentle shift. It is, as we're talking about, pricing in less than 25 basis points of cuts for the next meeting. Bank of America says that the options market is pricing more than a 1% move in the equity market. But you know that whole thing, it's just 1 month, take a step back, take a deep breath. I think that should count for the good data as well as the bad data.
I agree with you. November 7th, things could be very different for this Federal Reserve. There's one more jobs report still to come and an election to get through as well, if we even have a result by the time we get to that Thursday rate decision from the Federal Reserve. But we're making some moves on Wall Street. Goldman Sachs with a new year-end price target of 6K, a new 12-month price target of 6,300. Mike Wilson of Morgan Stanley upgrading the cyclicals to overweight relative to defensives.
It's really reawakened the bulls, and it's perfect. It's perfect for them. You have an economy that is still strong. You have a Fed that's still cutting. You have China dumping stimulus into the market. It's hard not to be bullish right now, John.
Your equity market pulling back just a touch on the S&P 500, down 0.5%. But check out this, the euro. The euro is negative for a 7th consecutive session. It's a break of 110 from Friday. That is the longest daily losing streak going all the way back to April 2022. Anne-Marie, 2 stories here. Data's better in America. Data's dreadful over in Europe.
It is dreadful over in Europe, especially basically what's going on in Germany. And many would point to basically a recession happening. The manufacturer sector there is not picking up speed. Mohamed El-Erian today in his opinion piece talking about the exceptionalism in the U.S. economy and how it's even more exceptional when you compare it to what's going on in Europe and also what's going on in China.
Euro dollar 109.61. There's one more thing I want to pick out on the screen there. It's crude. Rallying once again this morning. Danny, we're still waiting to see what the response will be from Israel to Iran.
And then we're 1 year on at this point, and we're still in a scenario where Israel is fighting 2 land wars, one in the air, if you want to count this fear of retaliation against Iran. This is the unknown, and that kind of bullish narrative we're talking about. It's this and U.S. elections, and those are very large unknown, John, and might hold people back from being able to go full force into this market.
Goldman Sachs over the weekend, Brent could surge to the 90s if Iran's oil supply is disrupted. I will also say over the weekend, you have the Israeli defense minister who's going to be traveling to the U.S. this week, speaking to Fox News, saying all options right now are on the table when it comes to the retaliatory hit against Iran.
Brent crude just short of 80, 79.75. Your hour ahead looks like this. We'll catch up with Katrina Dudley of Franklin Templeton in the soft landing camp, Nela Richardson of ADP ahead of the latest US CPI print, and Elliot Ackerman, former White House fellow, 1 year after Hamas attacked Israel. We begin this hour with stocks on pause after Friday's blowout payrolls report helped send the S&P 500 to the longest weekly winning streak going all the way back to May. Katrina Dudley of Franklin Templeton writing, we continue to believe in a soft landing, which is bullish for equities compared compared with the more bearish expectations of an imminent recession. Katrina is with us around a table here in New York. Katrina, good morning.
Good morning.
Let's start on Friday. It's like Friday never ended. What did you make of that?
I think that we've had some bullish momentum in the market. We have been in the soft landing camp for a long period of time in terms of we think that there are so many tools that have been available to be able to kind of land this economy on that landing strip and do something in terms of, managing the inflation and getting that down, which I think we can kind of check mark on that. We'll see the data that comes later this week. You look at the employment outlook, it's been bullish, people are good. And so I think that the Fed has actually done a very, very good job here.
There's a feeling on Friday that good news is still good news. Equities were higher, bond yields were too. They're up again this morning by 7 basis points at the front end, on a 10-year up by 3. Should they be anxious? Should equity bulls be anxious about what's developing in the bond market again?
I think that I grew up where we used to look at the bond market and it would inform us as equity investors. And now I think that the narrative has shifted. I think that we've got so many indicators coming out of equity markets. And I think that the equity markets have been at the forefront of some of the bond markets. So,
Katrina, you also, though, mentioned some of the bearishness in the technical backdrop. The fact that hedge funds need to take down their exposure with the volatility, that corporates are in a blackout period. How much does that weigh on a potential rally in this equity market?
I think if you combine those two things, which are the kind of the hedge fund exposure, you look at the fact that we've got this blackout period, and buybacks have been a big driver of some of the earnings growth as well as the incremental buyer in the market. And then we cannot forget about the election. The election is causing uncertainty because we actually don't know who's going to win this time. And, for a lot of people, that's good news because it means it's still up in the air and there's still a chance for one candidate to pull ahead. But when you have uncertainty, the market doesn't like it. You'll see, the kind of those spikes in volatility, and you'll see that uncertainty get priced in.
But for risk, with a really strong backdrop, how much does the election really matter? Besides the rhetoric, the potential volatility, does it really change the long-term outcome when you have earnings and expectations are really low, a potential bar to beat, and again, a labor market that's very strong?
I think in terms of the election, first of all, I think on tariffs, we're in agreement that both parties have got incentives to continue that tariff regime. So I think that way we can kind of say, doesn't matter which side, but think about taxes. That is the area. And taxes, I always look at an income statement. It's a big number. And so if you have you've got a lot of disparity in policy, particularly as it relates to corporate taxes. And obviously, if you have a regime where there's a reduction in the corporate tax rate, that is bullish for equities and the offset. So I think that that's the unknown that we have. And no, I don't think we're going to have the next day change in tax rates, but it could happen fairly quickly, particularly if you get a Republican sweep.
Well, also because TCJA is expiring next year, so taxes are completely in focus. But if you're concerned about the corporate tax rate, do you care more about the composition of Congress than you care about who's in the White House?
I still do care about who is in the White House because I think that is the driving force. That is a representation of America. So I think that they're the person who kind of drives where we end up as a policy. I think, as a country, we have this kind of tension in that we do believe that lower taxes are good for America. They're good for American business. But we do obviously have, some fairly high deficits out there.
We do, and there's new projections actually what those deficits would look like from Washington, from the Congressional Budget Office, about whether it's Harris or Trump. You mentioned inflation and tariffs. If you think both of these candidates are interested in using tariffs as a policy, and we just got data that showed wage growth accelerated, by next year, shouldn't we be concerned again with inflation?
I think on the wage growth front, that's a really big lagging indicator in terms of the inflation outlook. So I would say that any kind of job-related inflation lags what we expect to see. In terms of how do we expect tariffs to impact, it really depends on how we respond to them. If I have a small company, and the alternative is to buy something domestically versus a cheaper Chinese import that suddenly gets inflated up, it's good for America because I'm doing that in-house. So I think that the inflation number, it's not directly a corollary of the fact that I'm increasing tariffs and then suddenly I'm going to see inflation in America. I think it really is going to depend on what that adjustment is. And I think a lot of companies have been doing a lot of actions where they're matching their manufacturing to where they're selling so that these tariffs may not be as impactful as we initially thought.
Let's get your equity calls. The US versus the rest of the world. Within the US, large versus small. How are you thinking about things?
I think in terms of the US market, the momentum of the US market, and that is something that we're bullish on. We are concerned about that concentration. We've looked at the concentration, and there's no necessary research that kind of says, well, a highly concentrated market will sell off X%, because you have different situations. So on the concentration, though, that is something that worries us. We do see a situation where you can have some of these large cap companies flattish. And that means that they're going to grow their earnings, which is what the market's expecting, and they're going to grow. The valuation will decline as the earnings increase, and you kind of had a kind of tepid market return. And that's good for the overall equity market. What we're seeing is that that bullishness in the top of the market is starting to filter down. Where I think people are focused is going straight to small caps. But I think that there's actually a really big middle in America that is getting ignored. And that's the part of the market that I actually like at the moment. The small caps, in a regime where you're anti-FTC, may not have that takeout premium. So there's a little risk there. But that mid part of the market, I think, could actually be where opportunity is.
Is there a sector preference within the mid caps?
In terms of sector preference, I would go towards some of the industrial names where I think that they've got that resiliency to be able to take advantage of moving things around, that they're not going to be hurt by that rising tariff regime, and maybe they've got some ability to benefit from new policy.
There has been some of that. The Mag 7, it's 30% weighted in the S&P. Bespoke points out it's only accounted for 2.9% of the index's gains so far in the second half.
Yeah.
Is it a healthier market now?
I don't think it's quite yet healthy. I think you've still got those Magnificent Seven still dominating. Even the numbers you quote sound very small, but it's still dominating returns and dominating the narrative. I think that what we're seeing, however, is people starting to look at what are the second derivatives of, say, the AI, and that's where they're going into the mid-cap names. I also think that some of the exposure that you're looking at in the Magnificent Seven, people are starting to say, well, maybe I don't want an NVIDIA, I want an NVIDIA that, the second derivative. So the picks and shovels.
Do you understand at this point how big cap tech reacts to lack of Fed cuts, lack of magnitude of Fed cuts at this point?
In terms of understanding, I think that we have to go back to Finance 101. I'm so sorry, but the problem with some of these names, when you've got such high earnings growth expectation, which they're delivering on, let's to be very clear, any type of movement in interest rates, so much of the value is sitting in that terminal number that, interest rates become something that they're very, very sensitive to, even though you would say they're probably the least levered companies and they would have the least short-term exposure. But the valuation component and that terminal formula is what's really driving them.
Katrina, it's good to see you, as always. Thanks for catching up with us. Katrina Dudley there at Franklin Templeton. Your equity market on the S&P 500 down by about 0.6% across the bond market. 2s out to 30s. Yield shifting higher this morning. Let's give an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Boeing and its largest union are back at the negotiating table as they attempt to end a 3-week-old strike. Since the last meeting on September 27th, there's been little direct contact between the two sides, which remain deeply divided over a union demand to reinstate a defined benefit pension plan. But the economic pain is starting to set in for both sides. Last week, workers lost access to company-backed healthcare benefits, and each day the strike goes on, Boeing loses about $100 million in lost sales. Meanwhile, Pfizer shares are rising more than 2.5% in the pre-market on the news that activist investor Starboard Value has taken a stake of about $1 billion in the company. That's according to people familiar who say Starboard is seeking to mount a turnaround of the struggling pharmaceuticals giant. As part of the plan, sources tell us Starboard has approached former Pfizer executives Ian Reid and Frank D'Amelio to help, and they have expressed interest in stepping in. And Florida residents are bracing for another major hurricane less than 2 weeks after Helene killed at least 225 people across the U.S. South. Hurricane Milton could become a Category 4 storm and spark the largest evacuation in 7 years as it aims for Florida's Gulf Coast and Tampa. The storm has the potential to cause billions of dollars in damage and cause more misery for the region. Milton is forecast to make landfall on Wednesday. That's your Bloomberg Brief. John?
Yahara, thank you. It is the 1-2 punch everybody was fearing. More on that story a little bit later this morning. Up next on the programme, Elon Musk hitting the campaign trail.
He created the first major American car company in generations, and his rocket company is the only reason we can now send American astronauts into space. Come here. Take over, Elon. Yes, take over.
That conversation up next. Live from New York City this morning. Good morning and welcome to the program. Equities pulling back by about 0.5% on the S&P 500. A 10-year with a 4 handle. We're up by almost 4 basis points at 4.0% on a 10-year in America. Under surveillance this morning, Elon Musk hitting the campaign trail.
He created the first major American car company in generations, and his rocket company is the only reason we can now send American astronauts into space. Come here. Take over, Elon. Yes, take over.
This is a must-win situation. Must win. So I have one ask for everyone in the audience, everyone who watches this video, everyone in the live stream. This one request is very important. Register to vote.
So here's the latest. Elon Musk hitting the campaign trail with the former president at the site of this year's assassination attempt. Elsewhere, Kamala Harris kicking off a week full of media appearances, making stops at the Howard Stern Show, The Late Show with Stephen Colbert, and The View. Bloomberg's Jack Fitzpatrick joins us now for a week full of campaigning. Jack, I just want to reflect on the weekend, how unusual it is to see the CEO of one of the biggest companies in this country campaigning with the former president. How unique is that moment?
Very unique, and it speaks to Elon Musk's place as, at the very least, a commentator and a player in U.S. politics. He was harder to pin down even just a couple of years ago, but now he is fully behind former President Trump. He's spending money on his behalf. He's someone whose politics were maybe a bit more nuanced or divided previously, but he is a supporter of Republican politics and seems determined to use his clout to about as much as he can to help Trump win the election. It's a strange set of circumstances. It plays into plenty of questions about X and the future of social media's role in political communications, and yeah, it boils down to it's unique, it's strange, it's a little hard to predict the influence that it's going to have in November.
Well, let's look at some of that influence. The Musk-founded America PAC. I'm on their website right now. It says join our team. Email if you're interested. Jack, the pay starts at $30 per hour with bonuses for performance. This is according to the website. How much money really is Elon Musk willing to go to back the former president?
That's a good question. It may be the case that using X to amplify voices that he wants to amplify could end up being a more significant prospect there. We've seen plenty of big spending in U.S. elections since the Citizens United decision. Elon Musk is not a unique figure because of political spending through his super PAC or anything like that, although that does show you where he's going. It's more the personality, the aggressiveness of him now very clearly taking sides, the spotlight that he has drawn for a very long time. That is what makes it more of a unique situation. There have been other people who have spent plenty of money on elections, and Musk may do so, but it's not just the money. It's really the personality, the fame, and the influence all in one that makes him a significant player.
Jack, can we think of a similar name that is doing the same for the Harris campaign?
No, but Republicans will point out, and they are correct to point out, that Democrats for a long time have had the advantage of celebrity on their side. And so you see it all over the place with a variety of celebrities. I mean, George Clooney was somebody who had a significant role, it seemed, in getting President Biden to hand off the baton to Vice President Harris as the Democratic nominee. So there may be a number of Republicans Republicans kind of saying that this is a little bit of karma in terms of the celebrity support that plays into this. There's not really one person. I would say if you're looking for an outsider who is using celebrity fame, influence, sort of a technological side of this, there's really one person. It's just Elon Musk who's having his kind of influence on a U.S. election.
Jack, for the week ahead for Harris, John laid out the media interview she's doing. We'll hear from her 60-minute interview today. She's on The View, Howard Stern, on a podcast. A lot of the time, the language around Harris had been that it behooves her to avoid media interviews, that she's better off not doing it. What does it say about the campaign that she is committing to some now?
Well, first, it definitely says we're in crunch time. When you get that compare and contrast between Elon Musk jumping up and down saying this is the most significant election in our lifetime, and a string of media appearances, and a pretty varied string of media appearances by Harris, from the more traditional 60 Minutes to the Call Her Daddy podcast, you can tell the pressure's on. There was a bit of a pressure campaign to get Harris to interact more with media, whether it's news media or otherwise. That seems to have gotten her out there a bit more, answering more questions, having more interactions. She put out the more detailed economic plan. It's a very, very close race, and it seems that both candidates do realize that. And I think at this point, it's just very clear we're getting closer and closer to the election, and both candidates are doing everything they can.
Well, by going on Call Her Daddy in The View, I mean, that is clear, Jack, that it's a women audience. It's a women-based audience. But something like 60 Minutes, it was focused on Israel, at least the bits that we've heard so far that CBS has released. She was talking about the need to put pressure on Israel. From what we've seen, Jack, how does it come across with how the campaign is trying to convey her message around Israel?
It really highlights the difficult position that Democrats are in. They do not have as simple an answer on Israel. In the preview to the 60 Minutes interview, Harris said there is an important alliance between the American people and the Israeli people, pointing out the people almost seemed to be drawing a distinction from Netanyahu himself, but also said that she would pressure Israel to try to find a ceasefire that includes the release of hostages. Really, there's a needle that needs to be threaded by a Democratic candidate that you see in that preview to the Harris campaign that's more complex and more difficult for them than what you hear from Republicans, which is a pretty consistent cry that Democrats have not stood by Israel enough. They haven't been tough enough on Iran. And I think you'll probably see that in this 60 Minutes interview if we see more than just the preview that's come out on Israel, that she's threading a needle and trying to take a nuanced tone on a tough subject for Democrats.
Jack, just very quickly, will Congress come back to aid in the hurricane relief?
It does not seem like they will. They have what they need for immediate needs, despite some misinformation out there on exactly what's going on. They can spend as needed for Hurricane Helene and Hurricane Milton. They have put off some longer-term disaster work, so in December they'll have a lot of work to do that they could have gotten ahead on. But in terms of immediate needs, they don't actually need to come back.
Jack, got to leave it there. It's good to catch up, sir. Jan Fitzpatrick there of Bloomberg Government. Thank you. More on the hurricane season, particularly the 1-2 punch that Florida's about to take in the next couple of days. In just a moment, I want to talk about also the prospect of not being able to vote in places like North Carolina, how difficult it's going to be for some of these places.
You have to think that some of these people are still trying to get their power back. They're still trying to access clean water, let alone thinking about going out to vote in the November election.
More on that story in just a moment. Coming up on this programme, we'll catch up with Nela Richardson of ADP as traders await US CPI on Thursday, and this market still reacts to payrolls from last Friday. Equities right now pulling back on the S&P 500, down by 0.5%. In the bond market, it's a 4 handle on a 10-year, and a moment ago, it was the same thing on a 2-year. Your 2-year yield in America up 7 basis points, 3.99. Here come the bulls. Max Kettner, HSBC, This report, the payrolls report, reaffirms our very bullish stance on risk assets. Citi Stewart Kaiser, there is a window for markets to rally into the election. This morning, we pulled back just a little bit on the S&P 500. We are negative. We're down on the Nasdaq. We're down on the Russell. We're off by about 0.5% across the board here, following 4 weeks of gains on the S&P 500, the longest weekly winning streak going back to May. In the bond market, a whole new look. Yields up big time on Friday, and the move continues this morning. The 2-year up 7 basis points. The 10-year is up 3 or 4. We're back to 4% on a 10-year yield.
Yeah, I mean, what would it mean if we inverted again? I mean, that would be madness. It is the narrative back and forth, and now we can look reflexively back on the last month's data, not just on the jobs report, but on the upward revision to GDP, on the upward revision to GDI, and say, hey, things actually under the surface are looking a lot better. Consumption is still there. This economy is powering forward. Now maybe we just need to worry about inflation.
So we've gone from 50 or 25 to 50, 25 or nothing. Zero. BMO's Ian Bingen on inflation. Recall the Fed is normalising, not easing. The only thing the Fed needs to see in order to justify a quarter-point cut at its upcoming meeting is further progress on the inflation front, CPI Thursday.
If they didn't go the next meeting, if they held, would it mean that 50 looked like a mistake? What are the optics of going zero after you just did a jumbo rate cut? That might be why they are so sensitive and maybe looking for an excuse to cut 25 next time around.
Joe Meyer, Capital Economics, says he's raising the question, quote, whether the Fed needs to cut at all in November. That 50 basis points cut, does that look like they moved too quickly? Had they known this jobs report, would they be doing 50 or potentially would that have been a 25?
We'll keep repeating this exercise. Just think about how far away November 7th feels, how different things could be. They'll have another jobs report, they'll have CPI on Thursday behind them, they'll have a decent understanding about what they're hearing from corporate America as well. And we may or may not have an election result as well that week. November 7th is still a lifetime away.
There is so much uncertainty at that point. And again, that uncertainty might make them want to cut 25, because how does it look if they went 50 before an election happens, and they don't move at all? There are just so much optics behind this, and they can say we're independent from the politics, but they can't be, because the politics ties two vastly different outcomes when it comes to things like the fiscal deficit and tariffs. So they can't be apolitical.
So that's the US side of the trade. You've got to compare and contrast that with the European side of the trade. So take a look at euro dollar. The euro negative against the dollar for a 7th consecutive day. This is the longest daily losing streak for the single currency in Europe, going all the way back to April 2022. And the two pictures right now are stark. The contrast is pretty vicious, actually. Europe is dreadful, and America, based on those numbers on Friday, is better than okay.
Well, remember that conversation we had to start the year? What does it look like if America doesn't cut and the rest of the world wants to do a cutting cycle? What if we get, say, another 25 basis point cut and we're stuck at 475 on the Fed's rate? What does that mean for Europe? Europe right now, which is trying to tackle deficits. France saying that they're delaying their ability to get within target. The UK that's talking about enacting taxes. How unappealing does European debt look if the Fed does indeed need to pause?
The next ECB decision, 10 days away, October 17th. So look out for that. Under surveillance this morning, the Middle East, marking 1 year since the October 7th Hamas attacks on Israel. Israel sending troops back to northern Gaza and ramping up strikes on Lebanon as the government weighs how to respond to Iran's missile attacks just last week.
Devastating day today as we mark 1 year. President Biden will be speaking, joined by a rabbi. There'll be a candle lighting, as well as Vice President Kamala Harris. But right now, what we are dealing with on the ground in the Middle East is this concern about a broader conflict. And Israel right now is on multi-front when it comes to what they're dealing with these attacks. The biggest question remaining is how are they going to respond for Iran's most recent retaliation towards them?
Well, when this happened a year ago on October 7th, the biggest fear was a wider regional conflict. I think we can safely say that it is here. The wider regional conflict has happened. Israel is still fighting Hamas. There's still hostages in Gaza. They're now fighting in Lebanon. They're now talking about retaliation in Iran. And we don't know what's going to happen. We don't know what's going to happen here, and it's still a year on, and more is involved. It is the fear come alive.
And confronting the very real risk that the energy infrastructure in Iran might be targeted. Brent crude just short of 80 this morning, 79.70 up by more than 2%. Similar move on WTI crude through 76 at 76.19. Elsewhere, Florida preparing for the arrival of Hurricane Milton. Expected to make landfall near Tampa Bay on Wednesday. The storm could reach Category 4 power and may spark the largest evacuation in 7 years. The region still recovering from Hurricane Helene less than 2 weeks ago. The 1-2 punch nobody wanted to see.
It's devastating because now they realize they are not out of the woods when it comes to potential hurricane disaster. Pine Ellis, the county that has Clearwater, that house St. Petersburg, it has a lot of long-term care facilities. They are telling all of these hospitals, all these facilities to please evacuate. The sheriff over the weekend said, we know sometimes bars and restaurants think they can ride this out and stay open. We will shut you down. There's a tremendous amount of concern right now in Florida, and they are still dealing with Hurricane Helene.
And I think that's part of the difficulty here is FEMA workers literally were just leaving Florida to go to North Carolina to clean up the debris. And now they have to turn around again. It is the allocation of resources which gets really complicated. Resources which I should say are necessary not just to help human and preserve human life, but also with an election just weeks away. And this is hitting some areas that are crucial for these swing states, especially for the Republican candidate.
Absolutely, which is why potentially if you're a Republican, some of these states, potentially there was already early voting, you would hope that they voted already. That is why this has been politicized so much this time around. You have a lot of governors come out that are Republican. I've spoke to a few of those offices, and they said, look, we're getting everything we need from FEMA and the federal government, but the former President Donald Trump has really wanted to make this political because we are 1 month away from an election.
It's a difficult moment for that part of the country, that's for sure. Let's get you the latest on China as well. Chinese markets are still closed. I believe they reopen tomorrow. Goldman Sachs upgrading its call on Chinese stocks to overweight, expecting Chinese equities to rise another 15 to 20% if authorities deliver on stimulus measures. HSBC and BlackRock making similar calls recently in the last week, following this massive move we saw to Chinese equities going into the holiday period.
I think one of the big takeaways from this is there had been this idea there is no alternative than U.S. stocks. We're talking about how weak Europe is. Not only is China an option now, but what about the proxies? What about emerging markets, which have also been so underloved? What about European exposure to China? This changes a lot that there are stocks beyond just the U.S. So if you're bullish on this, you kind of have to be bullish on other parts of the world too.
The Hang Seng over in Hong Kong up another 1.6% to kick off the trading week. Traders bracing for a busy week of data ahead with Fed minutes on Wednesday, CPI on Thursday. Nela Richardson of ADP writing any sign of reacceleration in service inflation would be seen as a challenge to the Fed's aggressive rate cut last month. On the other hand, a drop in core CPI could be one of the final data points the Fed needs to commit to a long-term strategy on rate cuts. Nela joins us now for more. Nela, good morning.
Good morning.
Got to start with payrolls on Friday, haven't we? I keep doing this, but I don't think the weekend ever really happened for a lot of people. Friday drops, boom, wow. How consistent was that, or inconsistent with the other data we've seen in the labour market?
You know, nothing leading up to Friday would have prepared anyone even watching closely for Friday. There were some signs that we were going to see a stronger jobs report. We saw job openings tick up a little bit. The ADP report showed some strengthening. We know that layoffs have been very, very low. And so there were signs that there was strength in the economy. But those strengths didn't lead to 254,000 jobs being created. And I think it's time to really talk about the effect of uncertainty in this economy. Because when you think about the hiring over the summer and you compare it to September, there's such a big jump. You have to wonder if firms were kind of sitting on their hands, waiting for a rate cut, waiting for a reason to hire, and they found it in September.
Let's build on that. I think it's a really important point. Are we suggesting that Fed's rate cut had an almost instantaneous impact on this labour market?
3/4 of the hiring were in sectors that are not as sensitive to interest rates. It was government hiring, leisure and hospitality, and healthcare. A rate cut doesn't have the same punch in those sectors as it would be for manufacturing. Manufacturing shed jobs in the BLS report. So that tells me that this was not a rate story. This was a certainty story. Seeing that the Fed had committed, at least it looked like, to a course of action, which was a rate cut, meant that companies now had one level of uncertainty removed from their hiring practices. Now, there's still a lot more uncertainty in the economy. You just read through the headlines of a lot more going on, but it shows the power of uncertainty and how that's very different from risk. Risk employers can control, they can build scenarios around. Uncertainty is an unknown that they can't really ballpark, and that's the difference.
Does that also then mean that the lag of monetary policy when we are cutting is not as long and variable as it is when we are hiking?
It could mean that, for sure. I mean, what we're lacking in a data-dependent Fed is commitment. And this is a lesson for the Federal Reserve, because clarity is the antidote to uncertainty. So if they can commit to an action that will go through this preponderance of data that shows that the economy is in pretty good shape, then that gives the market something to grasp. We've gone from 2 scenarios, soft landing to hard landing, to 3 scenarios, which is no landing. That is not a great place to make decisions. The Fed could play a role providing that clarity, showing that, look, we are landing this plane and we're landing in a really great place for the economy. That's what's missing.
Well, just to that point, I mean, we're getting plenty of Fed speak. Bowman, Kashkari, Bostic, Musalem, all speaking just today, and there's plenty more throughout the week. What kind of tone do you think would help get the markets there, would help portray this after such a big jobs report, which, again, it is just 1 month?
You know, you might get very different notes from all of this Fed talk. You might see maybe a Governor Berman saying, look, this is another example of why I dissented from that 50 basis point rate cut. You might see other members of the FOMC saying, look, we're just going to look at the data and be very data dependent. I'm not sure that's going to work in their favor, because the data may show all kinds of things, especially in this 30-day period prior to an election. The data is going to be critical, but it's going to be interpreted with a slant. And so we don't have the benefit of an objective analysis of data when we have this big overlay of the election. So what I'd hope to see is some commitment to a path forward in every single speech. I don't think we'll see that.
Nela, you mentioned no landing. That seems to take on a different definition to different people. What do you subscribe a no landing to? What does it look like?
I honestly think this economy's landed months ago, and it's time for someone to call it. We've landed. It's good. We can start. We can commit to a very moderate interest rate cut, given the strength we're seeing in the economy, and we don't have to get over our skis. The fact that people are hesitant, that are staying on the sidelines, not just calling this for what it is, a strong economy, is mystifying to me. So I think we can call it and end some of this uncertainty about the direction of the economy.
This brings in CPI, and we can finish there. We can still reduce interest rates in this country, even with jobs reports like Friday, so long as Thursday cooperates. Is that fair?
I think that's fair, but it's with a caveat, because what's really, hurting the Fed's case on this is not the jobs market, it's the housing market. And it's a market that the Fed can't control as easily. I mean, not to say that they can control the jobs market, but the fact that there is all this demand out there, that there is a tailwind of demographics that increase the demand for housing, and there's not enough supply, means that, service inflation is with us. And there's not a lot the Fed can do about it. So how they telegraph that is going to be very, very important.
Nela, it's good to see you. Nela Richardson of ADP. On the latest in this bond market right now, we've got a 2-year, back through 4%, up 8 basis points on a session, and the difference between a 2-year and a 10-year, dead flat, zero, nothing. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Arcadium lithium shares are soaring in the pre-market, up 36% after Rio Tinto confirmed it's made an approach to acquire the company. Rio says the approach was non-binding and there's no certainty any deal will be agreed to. The move is yet another signal of a sector turning its attention back to growth as miners increase their exposure to metals involved in the energy transition. As early as 3 months ago, Citigroup analysts suggested Rio should buy Arcadium, with the lithium miner trading well below replacement value. Meanwhile, Nintendo shares are rising more than 4% in Japan after a senior executive with Saudi Arabia's sovereign wealth fund told local media it's considering increasing its stakes in Japanese game companies. The Saudi sovereign wealth fund is already one of Nintendo's biggest shareholders with an 8.6% stake, according to data compiled by Bloomberg. And Warner Brothers' new sequel to The Joker is off to a rough start at the box office. The highly anticipated blockbuster pulled in just $40 million in its opening weekend at U.S. theaters, falling short of even the most modest projections. The film, which returns Joaquin Phoenix to the title role and brings on Lady Gaga as his partner in crime, reportedly had a budget of over $200 million. That's more than 3 times the original movie. It's also failed to impress critics with a 33% score on Rotten Tomatoes. That's your Bloomberg Brief. John?
Yahara, thank you. Absolutely bombed. Haven't seen a trailer. but I've seen a ton of bad reviews, and I think that put a lot of people off over the weekend.
This is my bone to pick with this and other movies too. If it's a musical, tell people it's a musical. You shouldn't be sitting in a movie theater and being surprised everybody's singing all of a sudden.
I had no idea it was a musical.
Yeah, it's a musical.
But I haven't been back to the theater since the pandemic.
You doing a sing-along at the movie theater?
No,
Does it bring you back
absolutely
in?
not. No.
Okay. Up next on the program, 1 year of war in the Middle East.
When we think about the threat that Hamas, Hezbollah presents, Iran, I think that it is without any question our imperative to do what we can to allow Israel to defend itself.
The latest out of the region up next, live from New York City this morning. Good morning. Check out this move on crude. WTI up another 2.6%. Crude right now 76.31. That 5-day move, 5-day rally, almost 12% higher. 11.88% rally over the last 5 trading days. Under surveillance this morning, 1 year of war in the Middle East.
When we think about the threat that Hamas, Hezbollah presents, Iran, I think that it is without any question our imperative to do what we can to allow Israel to defend itself against those kinds of attacks, which include the need for humanitarian aid, the need for this war to end, the need for a deal to be done which would release the hostages and create a ceasefire.
So here's the latest. Israel ramping up strikes in Lebanon and Gaza as the nation marks 1 year since the October 7th terror attacks that launched the region into conflict. Joining us now is Bloomberg's Jemana Besechi for more. Jemana, good morning.
Morning. Well, it's October 7, and it is a somber day. It was a very traumatic day for Israel, but also a game changer for the country, because ever since that point, they have had to reconsider how they think about security and their place in the region. And if you fast forward to today, we actually just put out a Bloomberg Politics newsletter, the title of which said, "A Year of Middle East Tragedy," which really highlights all of the actions that have been set in motion over the course of the last 12 months. If you think about it today, Israel is fighting a multi-front conflict. You have the ongoing war in Gaza, and if you look at the latest death toll put forward by the Palestinian Health Ministry, looking at 42,000 deaths there. And even though Hamas have been very much diminished in terms of their military capabilities, even this morning, rockets were being fired towards Tel Aviv, claimed to have been fired by Hamas militants. Yahya Sinwar is still operating there. There's still 100 hostages still held in captivity with no signs really of a ceasefire breakthrough. You think about the developments in Lebanon across the border there. There's a ground incursion that has been going on for a week now, ongoing airstrikes around central Beirut, around the border close to Syria, rising death toll there. The Lebanese Health Ministry put it at 2,000, more than 1 million people displaced. And then in addition to that, you have ongoing strikes with these Houthi rebels in Yemen who have been wreaking havoc across the Red Sea shipping routes. And then the big one, of course, is Iran, because if you think back to the last 12 months, there have actually been 2 direct attacks from Iran into Israel, the latest of which occurred a couple of days ago. And now the whole world is on alert to see how Israel are going to respond to that. So it is a very fraught time, but also, I think, notably, the pathway towards normalization or peace in the region has never appeared narrower than it does right now.
Jemana, well said. Jemana Besechi there of Bloomberg out of the region. Let's continue the conversation. Joining us now is Elliot Ackerman, US Marine Corps veteran and former White House fellow. Elliot, welcome back to the programme. We're still sitting here waiting to see what Israel's retaliation might look like against Iran. We can get to that in just a moment. I think we need to reflect on the last year and the fact that the battlefront has got bigger and not smaller. And we've been talking about this now for the last 12 months. What does winning look like for Israel, Elliot? What does that look like?
I think it's really important that we differentiate between Israel having a right to defend itself, yes, but Israel winning. And I think as Israel's ally, the United States, I mean, we have an obligation to join with Israel to make sure that they win this war. That's actually the quickest pathway to peace is victory. So what does victory look like? I would argue for the Israelis, they have strung together a series of successes in the last month and a half that they absolutely need to take advantage of. The successes being the decapitation of Hezbollah, the massive strikes against Hezbollah's leadership. I think they're at a point right now where if I were Benjamin Netanyahu, I would be strongly considering striking at Iran's nuclear capability and making certain that Hamas and Hezbollah are forces that can never threaten Israel again, and then looking to renegotiate security agreements in the region with many of the Sunni Arab nations that were poised to do so 1 year ago, right before the October 7th attacks.
Elliot, what do you say to those that say that if Israel was to do that, then it would probably push Iran to go even further and actually result in enriching uranium even further and developing a nuclear weapon?
Yeah, I'm glad you asked that question, because I think when we look at the war that's going on right now between Israel and Iran, and it is a war between Israel and Iran, it's happening in a broader context, which is the wars that are going on right now between a global axis of authoritarian nations, to include Russia. In that axis is also North Korea, and to a degree, China, that's tacitly allowing so much of this to go on. And so when we look at a country like Russia and Ukraine, one of the great mistakes and missed opportunities of the war in Ukraine was the fact that we as the United States didn't empower the Ukrainians to act decisively early on in that war, by giving them the weapons that they needed in short order, and allowed that war to drag out as it's now into its third year. And the cost for victory for Ukraine has become much higher. So for the Israelis, I would say if you want a long war, take incremental steps. If you want a short war, act decisively and try to achieve what seem for the first time now those attainable objectives. And I would not take too much counsel of people who tell you that you have to respect and fear these red lines, like the red lines Putin has put up and like the red lines the Ayatollah puts up, because I think ultimately they do not serve anyone's interest and they don't serve the interest of peace.
The objectives are obtainable, Elliot, but you still have a scenario where on October 7th, a year on, Hamas is still able to fire rockets at Israel from the north. How much longer could this conflict stretch on, even if, as you say, it looks like if it has the support of its allies, it could get there?
Well, I think that, the first thing that Israel needs to recognize, and I think does clearly recognize, is that this is a war being fought by proxies. So, yes, it's a war against Hamas and it's a war against Hezbollah, but it's really a war against Iran. And that by defeating Iran, by taking measures in which the Iranians no longer feel it's in their best interest to continue supporting their proxies, that's how you get these rocket attacks to stop.
Elliot, we've got to leave it there, sir. It's fantastic to catch up with you. Elliot Ackerman there, the former White House fellow on the latest situation in the Middle East, calling for an act of decisive measures going forward from here and maybe even a strike on nuclear facilities.
Well, I go back to what the defense minister of Israel said over the weekend, Gallant, to Fox News, asked about this. Could we see nuclear facilities? Could we see oil facilities be the target of some sort of Israeli retaliation? The answer was all options were on the table. Very different than what we heard from this White House, which was definitively, please don't touch those nuclear facilities and maybe best not to touch the Iranian oil facilities as well. And
increasingly over the last week, that's what this market has been pricing in, just the very real risk of that risk materializing. Right now, crude is up by more than 2% across the board. WTI, 76.30. Brent crude getting closer and closer to 80, 79.80. Coming up next on the programme, we'll catch up with Bob Doll of Crossmark, Heidi Crebo-Rediker of CFR, Torsten Slok of Apollo, who before he sits down will do a bit of a victory lap in a studio, I'm sure. Then we'll speak to Mike Collins of PGIM Fixed Income. All of that and more in the second hour of Bloomberg Surveillance.
Do you think that near term that the market could get choppy?
We actually expect some volatility here near term.
If you get a short period of volatility, we are absolutely going to be in there buying.
Any pullbacks here would be opportunities to position into equity markets.
This market has traded soft landing for the last 18 months. So I think the appropriate question is, what comes after soft landing?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Your equity market looks like this morning. Good morning. Good morning. Pulling back just a touch on the S&P 500. We're down 0.5%. On the Nasdaq, we're down as well on the Russell. Just a little bit of underperformance there versus the S&P. On a Russell, the small caps down by 0.6. Surprise, surprise in the bond market. Not lower yields, much higher yields. After Friday's blowouts report, the move continues. We're up by another 9 basis points on the 2-year. Check this out. 4 handles across the curve. 2-year, 10-year, 30-year. The 2-year, 4.01%.
And the market doesn't know what to make of what is going on with this jobs report. Was it an outlier? Did the Fed act too quickly, cutting by 50 basis points? What Mark Rowan told you, Jonathan, a very expensive insurance policy. Unemployment rate down. Wage growth came in hotter. Revisions came higher. Usually revisions are coming down. So now what do you do with this all? Nela Richardson says this idea of a no landing. She says the plane has landed. This is a good economy. Then you have to ask, why was everyone pricing in another 50 basis points cut in November? That has now basically come off the table. And base case for most people is 25. Even some are saying no cuts.
Did we really need that 50? Check out the Fed minutes later this week for more on that. The main event, though, CPI on Thursday for the economic data side of things, and then the earnings on Friday. We'll get bank earnings kicking off with JP Morgan and Wells, but the standout main event after Friday's big jobs print, it's got to be Thursday and CPI.
That jobs print allowed us to move on to an old devil that we know. It is inflation. And I think it's notable that today you have the bond market still selling off while the equity market decided to stop selling off, despite the fact that a blowout jobs report is good. It allows us to say, hey, the Fed's not behind the curve. Maybe it shows, as Jonathan Krasinski of BTIG says, that the upside is now limited. Not only do we apparently need to worry about inflation again, but we're heading into an election. The runway just isn't as big for equities, even if you have strong economic fundamentals.
Remember all that cash in money market funds still there, by the way? And everyone coming on this program saying trying to deploy that capital elsewhere. Go out along the curve. The curve's normalizing. It makes more sense to deploy that capital now. 2-year versus 10-year. Turned negative this morning.
Well, if you're worried about reinvestment risk, hey, good job. You can get back in now with higher yields. Maybe now is the time that we'll finally put cash to work. Probably not, considering it hasn't, considering people have gotten pretty used to being in cushy cash positions amid the uncertainty of the world. But again, that sort of criticism that you're missing something with yields starting to come down, now would probably be the opportunity to take advantage of that.
So here's the cross-asset picture. We've talked about it a few times. Equities pulling back, yields pushing higher, the dollar stronger. Look at the euro, negative again, 109.66. Standout move this morning. It's not just the economic data, it's the move in the commodity market. Crude up for a 5th straight session.
And this is how basically this cloud hangs over the Middle East right now. What is going to be Israel's response? Two different stories coming out of Goldman Sachs and JP Morgan when it comes to the commodity market. Goldman Sachs predicting Brent could surge to the 90s if Iranian oil supply is hit. Goldman Sachs, though, says that attacking Tehran's energy facilities would not be the preferred course of action. And they're actually looking for Brent to stay around $80 this quarter.
Right there, right now, 79.83. On Brent crude. Coming up this hour, we'll catch up with Bob Dole of Crossmark, saying central banks are helping risk assets. Torsten Slok of Apollo saying there's no need for further rate cuts. And Michael Collins of PGIM Fixed Income saying it's time to add duration. We begin this hour with stocks on a 4-week winning streak following stronger than expected economic data in America. Bob Dole of Crossmark Global Investments suggests it's hard to be bearish. Monetary policy is now easing, even though there is limited evidence that it had been a major drag for the US economy to begin with. Any caution towards equities has admittedly been wrong, or at least premature. Bob Dole joins us now for more. Bob, welcome back to the programme, buddy. Let's just pick it up where we left things on Friday. Payrolls, big blowout jobs report is good news when you're seeing this repricing in the bond market.
First of all, it was 1 month. Look at all the prior months. How many downward revisions have we had? I'm not saying it wasn't a good number. It was an outstanding number, no question about it. But when you look at the employment data around the ISMs, both manufacturing and services, they were weak. So which is it? Which has it right? Time will tell. But the inflation question, as you've all just been discussing, is back on the table.
So, Bob, it just raised an important question. Which one was the head fake? The summer deceleration or the re-acceleration coming out of the summer?
I think they're both true. Economies don't move in one direction nonstop. So I think we're going to have this fits and starts. Some people call it a bumpy landing. I like that term. And I think that's what we're in for. It's going to be a good number and then a not so good number. And it'll confuse all of us.
Yeah, great. Wonderful. Great to hear that, Bob. I know in the meantime, you are looking for a significant economic slowdown or mild recession. That had been at least your base case scenario. If this is just 1 month, does it change it at all, Bob?
It certainly lowers the probability of us getting that right. When I look at all the statistics over several months, to me, it's still pretty clear that the economy is slowing. We're seeing that in many of the employment numbers, notwithstanding last Friday's. We're seeing that in ability to find jobs, people trying to find full-time jobs, settling for part-time jobs. Economy slowing. We just don't know how fast that's happening. And of course, the Fed has seen some of that too. We got 50 basis points, but their number is still very high relative to other things. How many things can you find that have nominal growth as strong as the Fed funds rate now? So it is leaning on the economy even with this cut.
Can you just help me sort out then what kind of economic environment we're dealing with here, Bob? If you're worried about a slowdown, but now we need to worry about inflation again, how do you square all of those?
Oh, that can happen in many, many cases in the past. Economy slows and inflation's picking up. I'm not arguing for stagflation, but we've had that many times before. And I guess I should enter the fact that PEs are in the 20s. When the PEs are that high, things better be nearly close to perfect. So if there's fly in the ointment, whatever that fly is, that 22 PE has got to be questioned somewhat. Hard to see a lot of upside for equities. Maybe not downside, but hard to see upside.
Bob, I know you keep trying to stress that this was just 1 month, but how do we reconcile how good this month was, which all the survey data showing that actually jobs plentiful, that's coming down, while jobs hard to find. More people are saying that's what their picture is right now in the labor market.
That's why I'm raising the question that it's 1 month and all the other things, the same statistic prior months, all the other numbers are showing not so fast that the economy is great and that there are plenty jobs. So let's see what next month brings and watch all the other statistics as you just accurately point out.
Do you just then take maybe 60 or 70 off this payrolls report because of the revisions we've seen in the past?
That's probably not a bad thought. I hadn't come to grips with that, but that's probably a good idea.
Bob, I want to talk to you about what's happening in this bond market. We're starting to see a reinversion, never mind a disinversion. And Bob, I wonder for an equity market strategist, for an equity market investor, what they should be doing with what's happening in the bond market after we heard from tons of people coming on this program who were saying get out of cash, deploy it into risk, go out further along the bond market, take on duration in the bond market, take on credit risk. Bob, what's your advice now?
Yeah, I think people that have a lot of cash that have enjoyed high returns, put a little to work. The 10-year over 4 is a whole lot more interesting than the 10-year that was below 375, not but a couple of weeks ago. So I would take periods of weakness in the bond market and do some adding. You don't have to be a hero. Take your time. But that's what's weighing on the stock market, the rise in interest rates, the rise in oil prices. And, maybe the economy is okay, the employment report may say. But on the other hand, why are earnings revisions so negative for the third quarter?
Hold up, Bob. This is an important point. Are you suggesting we've got to the point in the bond market where yields up on good news is now bad news for equities?
Yes, I think, most people say when the 10-year gets above 4, we begin to have those problems. I don't know if it's exactly 4, but the pace of the increase in yields also, John, I think has to be brought into the equation, and that is weighing on stocks.
So let's get into the stock market. Lift the lid on the index. Where do you want to be? Where do you want to avoid with all of that in mind?
So I'm a broken record for quite some time. I've argued for companies with high earnings predictability, high earnings persistence, and strong and growing free cash flow. You might call that quality because all the unknowns we've been discussing and debating back and forth here, I want to have companies that are somewhat independent of the economy. Those stocks have done just fine as the market has moved higher. I think if we get any kind of selling squall, these names will do even better.
Bob, does that mean this market's ability to broaden out, to go beyond the Mag 7, go beyond the cash-rich companies, go into small caps? Do you not see the market able to do that then if you're still looking at this maybe safer part of this equity market?
So I'm not sure that the Magnificent 7 or 5 or whatever the number is the safest part because of the big valuation differential between the top 10, if you will, more than 30 times earnings, and the other 490, call it 18 times earnings. I think the market can continue to broaden. I'd say within the S&P, within large cap stocks, not so much down to small. We need confidence that we have a really good economy for the small stocks. to do well. And as you probably know, almost half of the Russell 2000 companies are losing money. That's not real attractive.
So, Bob, in this environment where higher yields can indeed punish equity markets yet again, how worried are you for Thursday's CPI report?
I think we have to have our antenna up on it. Look, I never say, back to the employment report, 1 month makes a trend, but this notion that the Fed had inflation under control, it's going to inevitably get to 2%, has to be in question. I've questioned all along. I don't think there's any way we get 2% inflation unless we have a recession.
Bob Dole at Crossmark. Bob, appreciate it, sir. You've been pretty consistent on that point. Good to catch up after payrolls on Friday. Looking ahead to CPI on Thursday. We're still vulnerable to this all flipping the other way with CPI on Thursday.
We are still vulnerable. And I think one of the important things that maybe we're missing is that 10-year yields have been moving higher since before the Fed's decision. This bond market has actually been telling us something even before the Friday pay report, that maybe 50 was too much, that maybe there's a threat of inflation reaccelerating, or maybe there's just so much volatility that you need to command a higher premium. There are still risks in this market that maybe we could ignore when we're all freaking out about recession, and maybe the jobs data lets us kind of put that back in the spotlight.
The commodity market's been a piece of that puzzle. The 10-year's up to 4%. The 2-year is up to 4% this morning as well. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Chevron has agreed to part ways with some of its assets in Canada. The energy provider will sell some oil sands and shale stakes to Canadian Natural Resources for $6.5 billion. The asset sale comes as Chevron focuses its growth plans on other parts of the world, most notably the Permian Basin here in the U.S. and the Tengiz field in Kazakhstan, where a $48.5 billion expansion project is almost complete. Meanwhile, Nikon shares are rising after revealing French eyewear maker EssilorLuxottica has taken a 5.1% stake in the company. According to a filing, the eyewear maker began accumulating Nikon shares in early August. Earlier this year, Nikon shared it plans to invest more than $600 million by 2030 to bolster its lenses and other offerings. And McLaren has announced the most powerful model it's ever made. The British supercar maker unveiled the W1 to mark the 50th anniversary of its first F1 championship. The W1 uses a hybrid gas-electric engine that can pump out nearly 1,300 horsepower, boasting a top speed of 217 miles per hour. If you're looking to buy one, though, bad news. Only 399 were commissioned to be built, and they've all been reserved. The car costs just over $2 million and will begin delivering in 2026. That's your Bloomberg Brief. John.
Yeah, Harry, thank you. Nobody around this table in the market for one, obviously. I think we all wish we were.
I feel like Piastri and Norris should get a commission for this car, because, come on, part of the reason it's so popular is that they're so dominant right now.
Did they get a free one?
Oh, I'd hope so.
To find out, you'd think they'd get a free one.
You'd really hope so.
Part of the PR around the vehicle. Up next on the programme, crude rallies on risk in the Middle East.
Could you clarify some of your comments yesterday with regard to strikes on Iranian oil facilities? What did you mean by them, given some of the reactions we're seeing in the market?
I'd be thinking about other alternatives than striking oil fields.
We'll talk about those alternatives up next. Live from New York City this morning. Good morning. Risk assets facing a few headwinds this morning, including this one in the bond market. Yields higher by 4 basis points on a 10-year, up by 9 on a 2-year. We're back through 4% across the curve. 2s out to 30s. Under surveillance this morning, crude rallies on risk in the Middle East.
Could you clarify some of your comments yesterday with regard to strikes on Iranian oil facilities? What did you mean by them, given some of the reactions we're seeing in the market?
Well, look, the Israelis have not concluded what they're going to do in terms of a strike. That's under discussion. I think if I were in their shoes, I'd be thinking about other alternatives than striking oil fields.
So here's the latest this morning. Crude oil rallying for a 5th consecutive session as the world awaits Israel's response to Iran's ballistic missile launch last week. Heidi Crebo-Rediker of the Council on Foreign Relations says the real risk may be an additional strike from Iran. Heidi joins us now for more. Heidi, I want to read that line again. The real risk may be an additional strike from Iran. Just explain to our audience what you mean by that.
So I spent last week in Riyadh in Saudi, where, as you might imagine, everyone was pretty laser focused on whether what Israel described as a significant response to Iran's latest missile attack, whether it would involve striking oil facilities and infrastructure, as you were discussing. But while there was nothing explicit said, the worry was that that strike on Iranian oil facilities would result in Iran targeting Saudi and other Gulf producers. And so while they have, reasonable relations with regard to managing oil and oil facilities, I think there's legitimate concern that there would be a potential for a residual attack as an Iranian response on other Gulf facilities.
What about, Heidi, the idea that Iran can also close the Strait of Hormuz?
So, that is an option. There's some analysts that say that would be catastrophic. I think actually there are other alternatives. If there were an Israeli strike on Iran and Iran did close the strait, Saudi and UAE both have capacity. They have capacity to bypass the Strait of Hormuz, and I think they have capacity to export via the Red Sea. And UAE has a pipeline that also has the ability to bypass, which is a stopgap measure. But in terms of the direct impact, there obviously would be a significant market reaction. But I think in terms of global oil supply, it could really mitigate some of the disruptions.
Heidi, as you look to what Iran's response would be once Israel decides to respond to Iran, what are the Gulf countries doing right now to try to mitigate any of the risk?
So I think they are in significant quiet consultations with one another to try and really keep temperatures down. It's in nobody's interest to have this escalate, and particularly escalate into a full-blown regional conflict. That's not only bad for commodity markets, that's bad for global markets for a whole variety of reasons that you're aware of. And so I think that the general attitude is let's keep the temperatures down and the conflict as confined as possible.
Heidi, you were the State Department's first ever chief economist. You looked at things like state warcraft. What do you think the U.S., the Biden administration, is currently looking at, but to potentially harm Iran right now and as a punishment?
So, obviously what's on the table for first the Israeli response is military, nuclear, or the oil infrastructure. There are already so many sanctions on Iran right now. I'm not sure what additional sanctions could be contemplated, but I think to the extent that the Biden administration has any sway over Israel, it would be to try and make sure whatever risk they're going to be undertaking is one that they fully understand and have some way to mitigate. But obviously, this is a highly volatile environment. The timing, given especially the auspicious date today of October 7th, I think that decisions are going to be made, and we'll see an imminent response.
Heidi, what I'm hearing from sources in Washington is that the administration is weighing idea of more sanctions. But is the issue more sanctions or just the enforcement of sanctions that are currently on the books?
So enforcement of sanctions would be a very important step. I think it's Iran has been exporting and China has been importing, in particular, a significant amount of Iranian oil. But it's always a combination of stronger enforcement in addition to layering on additional sanctions. And as sanctions work when you have sanctions that are imposed multilaterally far better than if you have just the U.S. Imposing those sanctions. So I'm imagining that conversations about sanctions are happening with allies and partners.
Heidi, can we do a little bit of scenario analysis? Because you said that the oil market could react really strongly with any Israeli attack on Iranian oil infrastructure. What could that look like?
So, I mean, you're seeing pressure on oil right now, and we've had. This is a crisis that's and a conflict that's 1 year into the conflict, and you haven't seen so much reaction in commodity markets, but the potential that we have now, Hezbollah has been to a large extent neutralized, and that was one of the bigger barriers to a direct attack on Iran by Israel. It sort of opens up the real possibility for disruption of a major producer and exporter.
How do you understand the Biden administration's ability, though, to speak to Israel and to be able to avoid something like that, to say this hurts us heading into an election and hurts other Israeli allies as well? So the Biden administration has done its utmost to try and influence the actions of Israel. And I think, they're strong defenders of Israel. And they are, I am sure, having the conversations that will help inform at least thinking what a broader escalation might mean for the rest of the world. But I think Israel's going to make its own decisions at the end of the day. They've shown that time and time again.
Heidi, appreciate your input this morning. Thank you. Heidi Crebo-Rediker there of the Council on Foreign Relations, with crude higher by more than 2%, approaching 80 on Brent crude.
And just within a few days, you heard Biden really take that pivot. He almost let you in on some of the conversations that were happening. There is discussions regarding Israel attacking Iranian oil facilities. And then on Friday, he said, I'd be thinking about other alternatives than striking oil fields. And that happened after we saw the oil prices really spike and hold on to those gains. You cannot get rid of this geopolitical risk premium. And Heidi's point is not so much Israel attacking Iran, but what Iran will do after that potential attack.
It depends what the objectives are when we start to think about what Israel is going to do to Iran. Is it a proportional response to hundreds of missiles being thrown in their direction? I'm not entirely sure what that even looks like. Or is it to go even further? Is it about really taking Iran on and ending what has been the axis of resistance for the last few decades?
Or is it potentially sending a message? We know where your nuclear facilities are. We know where your head IRGC individuals and personnel are. We really just need to wait. What we know now, though, is that according to Israel, all options are on the table.
Brent crude up by more than 2%. WTI as well, 5-day rally on WTI up by 2.5%, 76.30. Coming up on this programme, Torsten Slok of Apollo saying the bottom line is rates will stay higher for longer. Torsten said it a few times. He does not think that this economy needs interest rate cuts. He certainly didn't think we needed a 50. He thinks this economy is better than okay. And if Friday's payrolls report is anything to go by, it certainly is. Your equity market's pulling back on the S&P 500. We're down by 0.5% on the S&P. In the bond market, yields are higher by 8 basis points. The 2-year at 4%. So before we get into this, Mike Dyer of Roth has this to say. The September jobs data was much stronger than highly correlated survey data for September, raising questions about its veracity and sustainability. We'll have a very different view on this in just a moment, but just throwing that out there. Equities look like this on the S&P 500. We're negative here. Across the board, we're down 0.5% on the S&P. On the Nasdaq, we're down by 0.6%. In the bond market, yields are higher. Bob Dole of Crossmark on the programme just 30 minutes ago, making the case that maybe good news is now bad news because yields are back through 4%.
And what a joy that is for CPI coming on Thursday. Great, we have to worry about CPI again just when we thought we put it on the rearview mirror. I thought it was important, though, Bob kept emphasizing it is 1 month of data. We did this for the bad data. The bad data, we were able to say, hey, it was just 1 month, don't freak out. Maybe we should kind of approach it the same way, even if it is good data, that this is still an economy we don't fully understand and especially a confusing labor market.
Back through 4 across the curve, 2s out to 30s. Let's turn the page and get to the commodity market story. I want to look at Brent crude and WTI. We're up by more than 2% on the session. WTI on a 5-day winning streak, a move of almost 12% over that period, a move of 9 to 10% just last week. Big weekly gain.
Big weekly gain. The market is fully supplied. Demand is not necessarily fully there because we're still waiting to see on how the stimulus effects will take place in China. The issue is right now is the commodity market is very angsty when it comes to what is going on in the Middle East, and they are preparing for potentially this Israeli retaliation on Iran and what Israel decides to hit. And oil facilities clearly are in focus.
And this is just, again, another thing that needs to make us worry about inflation once again. We did hear from Bank of America. They put out their projections basically saying for every 10% rise in oil, it's a 7 percentage point increase in core inflation. What that essentially means is that it needs to get back above $100 a barrel to start worrying about inflation again. But you add in oil, you add in China's stimulus, and it's, again, these fears coming back into the market.
Ed Yardeni, with his note over the weekend, before we get too cocky, we should note that we aren't completely ruling out the possibility of recession because of a potential 1970s-style geopolitically triggered hard landing. He's looking at the crisis and what is going on in the conflict in the Middle East.
What did Mohammed say on this programme on Friday? Mohammed Al-Arian, inflation is not dead. He thinks we should still be paying a lot more attention to that. CPI is coming out on Thursday. Under surveillance this morning, the US Southeast, preparing for its second major hurricane in less than 2 weeks. Hurricane Milton could strengthen to a Category 4 storm as it moves towards Florida. The governor, Ron DeSantis, declaring an emergency in 51 counties.
Very sad what's going on right now in the southeastern states. Danny brought up a great point. A lot of those FEMA workers were leaving Florida to go help other areas. Potentially now they will need to be coming back. Also, over the weekend, Speaker Johnson saying there is enough federal funding right now. They don't need to bring Congress back. When you think of two potentially devastating hurricanes at the same time, maybe that changes.
And Anne-Marie, you've been great to point out that these are swing states that are being hit. Politico has figures that in 2020, Trump won 61% of the vote in the areas in North Carolina that have been declared a disaster after Helene. In Georgia, that figure is 54%. These are important regions for Trump if he wants to win these swing states.
And these are regions that right now, these areas don't have access, some of them, to clean water. They don't have the power, let alone are they really thinking about getting their balloted or lining up in a month's time. That's why this has become so politically charged.
It's a difficult situation. It could get a lot harder. Elsewhere, Boeing and its largest union heading back to the bargaining table. A federal mediator summoning both sides for talks today over wage negotiations. Since the plane makers' last direct meeting on September 27th, there's been little direct contact between the parties. Situation now for the union, do they think they've got the leverage that we've seen on the eastern Gulf Coast ports over the last few weeks?
Well, one thing going for them is that the strike here doesn't directly impact people. It impacts Boeing, but their customers are used to having to wait for supply for a very long time. But it's interesting, the conversation has been that Boeing workers can continue to strike because of the gig economy, that they're all taking on second jobs. One person who is striking, speaking to Bloomberg, said that he's supplementing his income by making T-shirts and selling them. You get the sense that this is a workforce that is angry and willing to make some sacrifices to continue the strike on.
But last week, workers lost access to the Boeing-backed health care benefits. Potentially that is what is pushing them to this negotiating table. They haven't been here since September 27th. So potentially losing that access, that benefit that I'm not sure you get when you decide to go into the gig economy, pushes them towards wanting to make a deal.
One to watch. Here's another one to watch. Rio Tinto approaching Arcadium Lithium for a takeover deal. If successful, it could be the most significant mining acquisition in over a decade. Arcadium's current market cap is $3.3 billion, about half of what it was worth at the start of the year. Rio Tinto for a long, long time. It was iron ore, it was copper, it used to be coal. Now it's aluminum. There's going to be a bigger and bigger focus on lithium in years and 10 years and decades to come.
Absolutely. Lithium, cobalt, this is what is going to power the future. And then when you look at what's going on in demand in the oil market and you look at gasoline demand in China, it's less. Why? Because more Chinese consumers are buying cheap EVs out of China. To power that, you're going to need access to things like lithium and cobalt. And that's why you're seeing this stock really take a rise.
Big move in that stock this morning. Let's get back to Friday's blowout payrolls report, reshaping Fed expectations for the rest of the year. Torsten Slok of Apollo saying there's no need for cuts. Quote, the Fed is cutting rates, which is boosting growth and inflation further. Combined with very easy fiscal conditions, the bottom line remains that rates will stay higher for longer. Torsten Slok joins us now for more. Torsten, good morning.
Morning.
You caught your breath after the victory lap around a studio table. It's good to see you, sir. How did you feel on Friday when that number dropped?
Well, I think it makes sense what's going on. I mean, as you just talked about, it's not clear that the data has been slowing down. GDP last quarter was around 3. The Atlanta Fed GDP now for this quarter is around 3. And if you take this combined with, broadly speaking, strong data on consumer, on durable goods, it makes sense that the labor market is also still hot. It never made sense to say, oh, the economy is good, but the labor market is bad. You can't have it both ways. Either it's good in the economy and good in the labor market. You can't have that the economy is good and the labor market is bad. That just never made sense. So that's why, given the economic data coming in, the totality of the data, as Jay Powell would say, I still think that it's very obvious that things are still chugging along.
Well, let's sit on the totality of the data. So the survey data last week, the ISM's employment component's not fantastic.
Well, the service headline was still good.
Well, we can get into that in a moment. The JOLTS as well. If you look at the JOLTS, job openings were up, but hiring was down, the quits rate was down. If things were great, you'd expect the quits rate to still be elevated. You'd expect hiring to be elevated too. Some people have pointed out that maybe this is inconsistent with the broader data. What do you say back to them?
Well, I think that what's going on in the JOLTS survey is really a normalization. Because in the JOLTS survey, what you also have that the layoff rate is still 1. The layoff rate has not gone up, meaning it's not the case that companies are firing workers. You're, on the other hand, just seeing a little bit less hiring. So that's just a normalization and combined, of course, with still steady immigration and at the same time tailwinds from defense spending, from AI, from energy transition, and consumers that are not very sensitive to interest rates going up because of locked-in low interest rates. We still have some fairly strong tailwinds to the outlook and less sensitivity to what rates are doing. So therefore, it still makes sense to believe that over the next several quarters, the economy will do just fine.
Well, it's that sort of thing that's allowed a lot of critics to look at this decision in light of the jobs data and say it was a mistake to go 50. But Torsten, is there a world where this jobs report wouldn't have looked as strong if they didn't go 50, that it helped maintain strength in the labor market and reinvigorate confidence?
Well, the key issue, of course, as usual, is what are the long and variable lags? The Fed textbook would say that's 12 to 18 months before anything starts to show up. But as we know very well, the stock market is now becoming a very important indicator for companies in terms of, are we doing well, are we not doing well, should we hire, should we not hire? And given the significant tailwind to risky assets, credit spreads are very tight, both on IG, high yield and loans, and also when it comes to the equities going up. All that made actually exactly imply that we have had faster transmission of monetary policy because the signaling, the forward guidance has been coming through a much quicker than what the textbook would have predicted.
Does that suggest then 50 was a mistake?
Well, Jay Powell said at the press conference 10 times that they did this to recalibrate monetary policy. So there was a lot of this time, of course, a discussion, as of course also you guys had a lot of here about why did they do this? What's recalibration as an excuse? And of course the excuse was inflation has now come down. But given that the economic data is still strong, it really is Goldilocks with inflation back close to 2%, and the economic data just continues to power along. So that's why the Fed is now stuck at a situation where they need to say, well, should we look at the economic data, or as you just said before, Danny, or should we turn to inflation and say maybe inflation is a risk of moving up again?
But when you look at the totality of data, and Jonathan pointed out that some of these actually are going in the wrong direction, besides this one unemployment point that was a blowout. Do you think the Fed will err on the side of cutting too much rather than cutting too little?
Well, the Fed has definitely had a tendency that the risk to the unemployment rate for the last 5 years has always been, in their view, that it would go higher. So that's why a very important discussion on that is, of course, well, where do they put the emphasis? Do they put the emphasis now on that it's not really only the JOLTS data that's weak, it's also a number of other indicators that have shown slight weakness when it comes to some specific small areas, but the vast majority of the data that comes in, consumers, in the daily data, you're still seeing restaurant data being very good, TSA data for travel still very good. You also have the debit card data from my Bloomberg screen, and spending on the daily data is also very good. So you have across the board a lot of indicators that still continue to be really moving along quite nicely. There is just no slowdown. It's very clear that the JOLTS data stands out on its own as a very special story.
So November 7th, what do you think the Fed should do, and what do you think they will do?
Well, the problem for them now is that they have pre-committed themselves too much to R* and to rates going lower. So that's why I do think that they will cut 25 basis points. But the key issue here is that all the incoming data being so strong is telling us that maybe R* is not 3%, which is where the Fed is saying it is at the moment. Maybe it is more like 4.5%, which we do in our own Kalman filters of estimating where it should be. So that's why we think that we are not too far away from the monetary policy stance currently being close to neutral. So if that's the case, we don't need a dramatic amount of Fed cuts. which has been even also put into the dot plot by the FOMC members themselves.
You sound vindicated. Do you think Governor Berman is as well on the FOMC? Has she got any company?
Well, she was the lone dissent, of course, saying, well, we should not have cut 50. Well, I do think that we'll get a lot of Fed speeches today, including Alberto Mussolem here at New York speaking, of course. So, but all that ends up, in my view, being very, very important for us to see, are they backpedaling now? Are they backtracking from this? Oh, we need a lot of cuts. Well, maybe we don't need a lot of cuts because the incoming data continues to just be strong.
They say they're not in a rush. Do you believe them?
I do believe them because think about what creates recessions. In 2020, the recession was caused by COVID. Of course, that generated a recession. Lehman Brothers, of course, that generated a recession. Prior recession, S&P 500 went down 50%. That generated a shallow recession. And prior to that, we had the commercial real estate crisis and the savings and loan crisis in the 1990s. Of course, that generated a recession. But where is the shock today? Where is the shock that should generate a recession? The only shock is we've had the Fed raising rates, but that's been countered by now AI spending, defense spending, fiscal spending. So that's why monetary policy has not been as restrictive as our textbook would have been saying. So that's why our textbook, we should probably put that more aside. And that's probably still a good recommendation for the Fed. Let's put this textbook aside and look at the incoming data, and the incoming data continue to actually be strong.
So if the neutral rate isn't as low, if monetary policy transmission when they're cutting is happening at a quicker speed, what will be the implication of them continuing to cut into strength?
Well, the challenge is that we still have the tailwinds from very strong spending from the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. We also have very strong tailwinds from AI spending. I mean, no one you meet says, oh, I'm not going to invest in AI because the Fed has just raised interest rates 25 basis points. Everyone still wants to invest in AI. And energy transition, we also have that as a strong tailwind. And finally, also deglobalization, the industrial renaissance, the construction of manufacturing plants in the US is also a strong tailwind. Those are things that the Fed can't really control because these are the stories that we talk about in markets at the moment. So in that sense, monetary policy is just unusually weak in terms of having a negative impact when rates went up on the economy.
Torsten, does the market still also have the tailwind of the Fed's first pivot of December 2023?
Absolutely, because in December, as we all remember, they clearly said now rates are going down. And before that, there was very little activity in IPO, in IG issuance, high yield issuance, loan markets. Everything was relatively weak and, broadly speaking, at a standstill. After the December pivot, they really have seen a significant opening of financing markets in all directions. And that's also exactly as you're saying, Anne-Marie, provided a very strong tailwind in easy financial conditions. And therefore now, if you are a company that want to do something in private credit, in private equity, a lot of more things are just possible relative to what we had earlier.
Torsten, it's good to see you. Wonderful to catch up. Congratulations. So far, so good after Friday. Torsten Slok of Apollo. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Donald Trump and Kamala Harris taking a break from campaigning today to recognize the one-year mark of the Hamas attack on Israel. Harris will plant a pomegranate tree on the grounds of her official residence in Washington in memory of those killed, while Donald Trump will attend a memorial service with Jewish community leaders at one of his hotels in Miami. Meanwhile, Foxconn saw its revenue growth accelerate after it hit record sales for the third quarter. Also known as Hon Hai, the main manufacturer for Apple, saw a 20% surge in sales, beating its own expectations. That's thanks to its growing business supplying servers with NVIDIA AI chips inside them. And it was a busy weekend of playoff baseball in the National League. Both series are tied at 1 game apiece, with the Phillies coming back for a walk-off win over the Mets after dropping Game 1 at home. Out west, the Padres rolled over the Dodgers, and in the American League, the Guardians will look to pull ahead from the Tigers after taking Game 1 at home. And elsewhere, the Yankees will host the Royals for Game 2 this evening in the Bronx. That's your Bloomberg Brief. John?
Yeah, thank you. Regular Mets updates just for Bramo. Bramo's not here. This is where Bramo will be tomorrow morning. Do not miss this. 9:30 Eastern Time tomorrow. Lisa Abramowitz sitting down with the JP Morgan CEO and Chairman Jamie Dimon. 9:30 Eastern tomorrow morning. Do not miss that conversation. Up next on the program, inflation isn't dead.
This notion that inflation is dead, this notion that we are mission accomplished, came way too early.
That conversation up next, live from New York. This is Bloomberg. Here's the stock market picture for you. We're pulling back by 0.4% on the S&P 500 in the bond market. We're up by 3 basis points. The 10-year back through 4% for the first time since August. The 2-year also back through 4%. We're up by 8 basis points at the front end of the curve on a session so far. Under surveillance this morning, inflation isn't dead.
I think this is pushing back against what has been, in my view, and you've heard me say it over and over again, an overly aggressive expectation of rate cuts by the Fed. This notion that inflation is dead, this notion that we are mission accomplished, came way too early.
So here's the latest. The 10-year yield hitting 4% for the first time since August following the blowout jobs report on Friday, leading traders to cut the chances of another Fed rate cut, a big one of 50. The door closed on that on Friday. Mike Collins of PGIM saying this: we're sticking with our call that there is better risk return in adding duration here than cutting. Of course, it is difficult to have a high conviction call on rates one way or the other right now, as the economic data, jobs and inflation have really been bouncing around. Mike Collins joins us now for more. Mike, I want to pitch up on Mohammed's line, and welcome to the program, sir. The notion that inflation is dead, this notion that we are mission accomplished, came way too early. Mike, do you agree with him?
No, I don't, right? Jonathan, we're paid really in this business to look for different paradigms than the one we're in. A lot of people this morning after Friday's, really strong jobs number are kind of jumping back on the strong growth, high inflation narrative bandwagon. And, there are other scenarios out there. Like I said, this is very difficult, right? Forecasting interest rates and even the path of the economy are always difficult. Today, just as much so. I mean, just look at the climate risk we're facing in the last couple of weeks in this country, right? I mean, it is a tremendous destruction of wealth, but it can also be inflationary. So you have a tug of war going on just from that one exogenous effect that we're seeing increasingly around the world. But there's this scenario, Jonathan, that prices stop going up, right? If prices, which are high across a lot of different categories, just stop going up for a year or two, inflation goes to zero, right? And that is a scenario that we're actually starting to put a little more weight on as a risk scenario that, heck, maybe these 0.2 and 0.3 inflation prints, which we're expecting later this week, turn into zeros and 0.1s, and then you're running at year-over-year inflation below 2 in 6 and 12 months from now. That is not at all out of the realm of possibilities. And in that world, rates are possibly 100 basis points too high. So I know Torsten Slok is painting a picture, maybe rates are 100 basis points too low. Maybe they're 100 basis points too high. And it is really difficult. But as investors, as long-term investors, you have to take into account all of these different scenarios.
Well, Mike, that's what it takes to make a market. Two very different views. So let's run with yours. We've got a 2-year right now that's reset at 4. The whole curve has reset higher in and around 4%. What do you do with this morning?
Yeah, I mean, we're advising our clients, and in fact, in our portfolios, we've gotten a little bit long duration, right? A month or two ago, when the 10-year was pushing down at 360, and there were tons of rate cuts priced in, it seemed like a little overdone in the near term. And I know we've spoken about that. And we were advising clients, hey, if you ever get an opportunity to buy the 10-year, in that 4 to 4.5% zone again, don't miss it this time. Take advantage of it. And right now we're right at the bottom, of that buy zone is what we're calling it, right? And I think, investors are probably going to take another bite at the apple here. I mean, we've seen flows coming into public fixed income in a pretty big way. They actually accelerated recently with the Fed's 50 basis point cut and with a slowing in economic and inflation data. And I think maybe investors this time will be emboldened to take advantage of this backup in rates and add duration. And I really think over the longer term, that's the right thing to do.
Mike, there has been some pressure on duration since even before the Fed cut 50 basis points. From the 16th of last month, the day before the Fed decision, 10-year yields nominally up 15 basis points, real yields up 19 basis points for the 10-year. What do you make of the drivers behind that? It's counterintuitive. You think the Fed's cutting, surely yields would be going lower across the curve.
Yeah, I mean, the markets overreact all the time, Danny, right? And I think that's what happened when the Fed, did the 50. The markets kind of raced ahead of them for even more cuts, right? There were, a full 75 basis points of cuts, almost 50 at each meeting at one point priced in for this year. I mean, that did feel like an overreaction in the near term. And I know that this giant liquid, most traded market in the world, U.S. Treasuries, are supposed to be an efficient market. But wow, human behavior really forces markets to overreact on the upside and downside all the time, especially during inflection points. So I think that was just a near-term overreaction on the downside. And the market started to realize that and get back to a more normal level, pricing in a longer-term funds rate of close to 3. Now, to your point, we're, almost 50 basis points of cuts have been taken off the table. We're kind of at a 330, 340 long-term funds rate right now, what we call the terminal funds rate this cycle. And could that happen? Could they stop at 340 and stay there forever? Yes. And maybe that's the view of the kind of the economic and inflation, bulls and hawks. But man, there's a whole host of scenarios out there where they get that funds rate into the 2s or God forbid, maybe even lower than that. And I think the markets now are maybe starting to go back up too much here and not price in those downside scenarios to growth and inflation.
And then you get to your call that way, Michael, of saying get out of cash, get into duration. I got to ask, are clients actually listening to you? Because cash funds have just been so much more sticky this cycle than so many people anticipated.
Yeah, they have. But I mean, you look at the flows, and we see our flows across a whole variety of different institutional, global, non-U.S., pension, insurance, high net worth investors, Danny. So we have a really neat spot where we sit to actually see every day the shift in the money. And increasingly, we are seeing the bigger investors, even retail investors, looking at fixed income and probably public fixed income, right? Because private fixed income has been really sticky, and there's been some disappointment in the liquidity there. Big money coming back into public fixed income, and maybe they get a little bit spooked with this backup in rates and pause for a little bit. That's very natural behavior, looking in the rearview mirror. But I think if you do get a rate settling here, kind of in the low to mid 4s, it's a big long-term buying opportunity, and let's hope everybody takes advantage of it.
Mike Collins of PGIM with a rallying call. Get into this bond market. Appreciate it, sir. As always, the opportunity to get another bite of 4% in the bond market.
Yeah, everyone was saying, hey, the reinvestment risk, it's here. You missed it. Already yields were going down. They're back up again. So if you liked yields below 4%, surely you'll love them back above 4% yet again.
If only that's how it worked, right? You get back through 4, you start worrying they're going to 450 and maybe even higher. The 2-year at 4% this morning, up by 8 basis points. On a 10-year, we're up by 3, just north of 4%. Up next on the programme, Ed Yardeni of Yardeni Research, Dana Telsey of Telsey Advisory Group, Greg Daco of EY, and Erik Knutzen of Neuberger Berman. The third hour of Bloomberg Surveillance is up next.
This is not just a solid labor market, it's a strong labor market late in the cycle.
This is not as tight of a Fed as the market, or really as the Fed thinks it is.
It's a labor market that looks okay, and probably 50 basis points is off the table. It doesn't feel like monetary policy needs to be acting at a fast pace. We expect it to be more gradual.
The economy is okay, and there's not any forcing issue here to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, the third hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500, on the Nasdaq 100, on a Russell, down across the board. On the S&P, we're negative by 0.4%. On the Nasdaq, we're down by 0.5. On a Russell, we're down by 0.4. On the S&P 500, a 4-week winning streak on a weekly basis, the longest going back to May. If you get to the bond market, the picture is very different this Monday compared to last week. Back through 4% briefly on a 2-year, likewise on a 10-year, 3.99. In and around 4% across the board this morning. Yields are higher at the front end by close to 8 basis points. Danny Berger, the commodity market, the source again for some of this move this morning.
It's inflation back in the concern. It's not just the commodity market, which it is largely. It's strong jobs, and it's also China policy. Stimulus coming into the fore. Remember that old thing of stimulus in China impacting the entirety of the globe? So you get this concern, not just stimulus, not just the oil market, but maybe the Fed policy cutting by 50 is the thing that reinvigorated this jobs market. And then transmission of policy happens quicker, which means the neutral rate isn't as low as we thought, which means more cuts aren't coming as much as we thought, which means that yields need to go higher.
We're getting some upgrades from Wall Street. From Goldman Sachs and David Torsten, new price target for year-end, 6K, up from 5,600. 12-month price target now 6,300. I mentioned Michael Wilson over at Morgan Stanley, overweight on the cyclicals relative to the defensives. Max Kettner, HSBC, the jobs report reaffirms our very bullish stance on risk assets. Stuart Kaiser of Citi, take a listen to this. There's a window for markets to rally into the election, save the Middle East and escalation or a large upside surprise in inflation on the 10th of October. Let's talk about the Middle East and the prospect of escalation. 5 days of gains for crude, a move of more than 11%.
And you're seeing upgrades from Wall Street on potentially where that price can go. Goldman Sachs talking about $90 per barrel on Brent, Jonathan, if Israel was to attack some sort of Iranian oil facilities. Heidi Crebo-Rediker, though, looking at what is the next domino to fall after that. What would Iran then do potentially to some Gulf suppliers in the Middle East? And that is why this is the concern. And I know we're going to be speaking to Ed Yardeni that says this is his big risk potentially of falling into a recession.
Brent crude 79.39 up by 1.7%. WTI up by close to 2. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research on why the Fed might be none and done. Dana Telsey of Telsey Advisory on luxury stocks following stimulus in China. And Greg Daco of EY on why the next payrolls report is the most important. We begin this hour with markets on hold as a strong September payrolls report puts stocks on a 4-week winning streak. Ed Yardeni of Yardeni Research thinks the Fed can take the rest of the year off. Following Friday's strong September employment report, Federal Fund Futures Markets predicts 5 or 6 rate cuts over the next 12 months. We're predicting none and done for the rest of this year. Ed Yardeni joins us now for more. Ed Yardeni, let's talk about that. Is that one jobs report enough to say they're done for the year?
I think it wasn't just the jobs report. We also had a very strong purchasing managers index for the services economy, and that's where the strength in the economy has been. Initial unemployment claims have remained very low. And so I think there have been actually quite a few numbers. As you know, the Citigroup Economic Surprise Index is positive again, and that's one of the reasons the bond yield is back up. It's a good indicator of the direction of the bond yield.
Ed, if you're right, and they are done, and we reprice this yield curve higher, and we reduce how many interest rate cuts are priced for the next 12 months, how well does this equity market perform, in your opinion?
Well, I think it performs differently. I think we've clearly seen that this bull market has been led by the PE. The valuation multiple has gone up dramatically. Earnings have also been going up, which you wouldn't really have a bull market unless you really had earnings trending higher. And for the S&P 500 that are all-time record high, that's not the case for the SMID caps, the small and mid cap S&P 400 and 600. Their earnings have actually been flat. I think the market continues to broaden, but instead of broadening out to the Russell 2000, which would be correlated with interest rates going down. If interest rates stay here, I think it broadens out from the Magnificent Seven to the S&P 493.
Ed, something is different, though, this time for this earnings season than it was in August. In August, we were talking about the high bar that equities had to reach. This time, it's somewhere below 5% that we're expecting earnings growth for this quarter. The bar is certainly lower. What does that mean? Earnings season is about to be upon us. Can this not be the leg of the next bull market rally, whether or not rates are being cut?
Well, my preference is exactly what's happening here. I would prefer that the market goes up on earnings from here rather than on valuation. This is not a cheap market. We've got the Buffett ratio. I think it's 2.8. It's at an all-time record high. That's the price to sales ratio. The forward PE for the S&P 500 is about 22, with the Magnificent Seven selling at almost 30, and the rest of the market at 19. So, you're not getting any bargains here, but what the market I think will do is go up on earnings. And we're going to have another quarter where earnings are going to go to a record high in the third quarter.
It has been a market, though, that has been able to rally without the Mag 7, without the mega caps for the most part. In the second half of the year so far, only 2.9% of the rally is attributed to those Mag 7 stocks, right, according to Bespoke. Ed, is it a market that, even though it is overvalued, at least is more healthy, at least is more broad?
Well, I think it's healthier if the stocks that go up, that it broadens out to, is the rest of the market, the rest of the S&P 500 beyond the Magnificent Seven. But again, those multiples which are at 19 could easily get over 20 here very quickly. And so I think the health of the stock market's going to depend on earnings. I'm a little nervous that everybody's turning so bullish, and all of a sudden everybody's talking about 6,000. I started out the year talking at 5,400 for the S&P 500 by year end, and that was an outlier. I had to raise that to 5,800, and now that's a meh kind of number where people are talking about 6,000. So I think there's a little bit a head of steam here building up that could be disappointed.
Ed, you were ahead of the curve. In your note today, you also talk about, before we get too cocky, you say we should note that we aren't completely ruling out the possibility of a recession. Right. What could trigger a recession for the U.S. economy right now?
Yeah, well, we had been thinking that the economy would surprise to the upside. We've been saying that for 2.5 years, that don't underestimate the economy, don't underestimate the consumer. Looking ahead here, we're thinking that the economy is going to continue to perform quite well. And so I think that's consistent with where the bond yield is. I think interest rates have normalized. I think the Fed really has to reconsider what is the neutral rate, which, by the way, I think is a fairy tale number. It doesn't exist. It's totally a theoretical construct. But all in all, I think the market goes higher on earnings.
Okay, but what about the geopolitics you also have one eye looking at?
Yeah, well, 20%, I don't want to get cocky about this thing as I wrote. I think there is a chance of a recession here, which is a 20% probability in our minds, and it is geopolitically related. I know it's a little bit hard to believe, but you look at the history of geopolitical crises, and more often than not, they've actually been buying opportunities. And the reality is this geopolitical crisis so far really hasn't given anybody a buying opportunity. So there's still a possibility that with this war between Iran and Israel getting to be a more direct confrontation, that there could be a sell-off related to that.
Do you think there's a part of the market then that's a little bit too stretched? Is it an index level call, a sector call? What is it?
Well, I think that it's stretched in terms of valuation, and I think that part of that is because we do have a very passive investment orientation in the marketplace. When people get into the market, more often than not, they're getting into ETFs, and ETFs really don't get very concerned about diversification. If you have an S&P 500 ETF and 30% of that is the Magnificent Seven, that's what you're buying. Whereas managed portfolios might be more conservative, and so that's not enough diversification.
I just want to walk away with the right impression of where you stand, and I don't want to mischaracterize you for the rest of the weekend. Yeah. At the moment, it sounds like you're bearish. Is that fair?
No, I'd say that our view is that we're at the right place in the market relative to valuation and earnings. I think we could get to 6,000. I guess what I'm saying is I hope we don't see a melt up here, because I don't like melt ups. They force me to have to figure out when to tell people to sell. And I think earnings are going to continue to drive the market higher at a slower pace.
So, Ed, if you think that we can continue to move forward, but there's some distortions in the market, it's overvalued, are you in the Cliff Asness camp of AQR, that this is a less efficient market and that these types of mispricings can continue on for longer because of forces like passive management?
I think that's a very good point. I agree with that. But at the end of the day, that's a theoretical notion. And the bottom line is this market going higher? And I think it is going higher. Look, we got $6 trillion sitting in money market mutual funds. They're an all-time record high. And so is the stock market. In other words, the stock market got to a record high without people actually panicking out of money market funds and getting into the stock market. So there's a tremendous amount of liquidity in the system, and there's a lot of buying on a global basis. I would continue to overweight the U.S. on a global portfolio. I think the China thing's kind of running out of steam here, and I think people are going to go back to overweighting the U.S. as kind of the safe haven in the global stock market arena.
Yardeni, let's finish there. What is it about China that you don't believe in?
Well, they've got some major structural problems. They created the government created its own mess here with the demographics. They got a very rapidly aging demographic profile. The consumers are stretched. I don't think they're going to be buying additional apartments. So even if they manage to stop the debacle in the property market, that's not going to be a source of economic growth. All in all, it's a government run, it's an autocratic government running an economy that's done extremely well when they let capitalism flourish. Now they're not.
Ed Yardeni, of Yardeni Research. I'd appreciate it, sir. Bullish US assets, just not as bullish as some are right now. Let's put it that way. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Former President Donald Trump is campaigning in key battleground states this week. He was in Wisconsin yesterday for his fourth visit in eight days. And on Saturday, Trump held a rally in Butler, Pennsylvania, the same site where a gunman tried to take his life in July. He was joined on stage by billionaire Elon Musk. The Butler rally was Elon Musk's most prominent moment in the campaign. He publicly endorsed Trump after that assassination attempt in Butler and launched a pro-Trump super PAC in May. Meanwhile, the Wall Street Journal is reporting that Vladimir Putin's, quote, merchant of death is back in the arms business. Victor Bout has returned to work brokering small arms sales to Yemen's Iran-backed militants, according to the Journal. Bout was traded back to Moscow in 2022 in exchange for U.S. basketball star Brittany Griner. And a warning for people who use over-the-counter acne medications. New analysis found that popular treatments were found to contain high levels of benzene, a chemical linked to cancer. Researchers tested more than 100 products and found about a third were contaminated with high levels of benzene. For example, Proactive contained 18 times the amount allowed by the FDA. This putting pressure on the regulator to take action on the products widely used by American teenagers. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, the morning calls, plus Nela Telsey of Telsey Advisory with luxury stocks back in the spotlight on the back of stimulus out of China. That conversation up next. City pushing back. Andrew Holdenhorst was looking for 70 on Friday. We got 254. This is what he has to say. The strong household survey was also entirely due to an abnormally large increase in government employment that we would not expect to repeat. We expect a reversion to weaker dynamics at some point in the next few months. That's the call from Citi this morning. Equity futures right now on the S&P pulling back by 0.4%. Some standout moves in the market worldwide, cross-asset, both in the commodity market and in the bond market. Yields back through 4% on 2s and 10s earlier in the session for the first time since August. In the commodity market, the rally continues. Crude higher by 1.8%. WTI just short of 76 now, 75.74. Time now for some morning calls. First up, Wells Fargo downgrading Amazon to equal weight, saying its positive revision story faces multiple headwinds. That stock is down 1.5%. Next up, Jefferies downgrading Apple to hold, citing overly optimistic expectations for the newest iPhone. We're down another 1% in the pre-market for that name. And finally, Macquarie upgrading Alibaba to outperform, seeing more upside for the China internet sector. That name is up another 2.5%. Let's stick with China. The government's recent stimulus sparking both an equity rally as well as optimism for a shift in consumer spending, benefiting luxury retailers. Nela Telsey of Telsey Advisory Group saying the China stimulus package is the largest since the pandemic. A plan to inject liquidity in the stock market should benefit consumer spending. China is very important to the luxury goods industry, with the highest share at around 31%, followed by the US at just under 25%. Dana's with us around the table. Dana, good morning to you.
Good morning. Thank you for having me.
Thank you for being here. Is it the real deal? Is it the real deal?
Let's see if it's the real deal. Certainly it propelled the stocks when it was announced, and we're going to have sales coming up in just 2 weeks. They're not going to look good. Overall, for most of the luxury players, if sales from China are down nearly 30%, would not be surprising at all.
How weak has North America been for these luxury players as well? And how much is that just to do with Chinese travelers not traveling that much anymore?
Yep. U.S. has been weak for luxury, but not to the extent that you've had China. I mean, it's single-digit weakness for the most part. And overall, the aspirational consumer is what's being impacted. We got the benefit during COVID of stimulus being added to the aspirational consumer that you don't have now. And you're seeing discretionary spend versus essential spend. Essentials is still holding firm. You need newness and innovation to drive demand, but higher prices don't help you in capturing some of that aspirational spend.
When you're looking at the luxury space, it feels very fickle right now on who's doing well, who's not. What's in trend, or maybe in trend, say, in China?
I think overall you're seeing some of the Chinese luxury brands be in trend, and that's been more important. You're definitely seeing, look at Tiffany, reduce the size of their flagship in Shanghai by around 50%. So it's a time when you're seeing the Chinese go to Japan, given the benefit they're getting from pricing in Japan as compared to China.
Is there a push in China? We've seen this in the mobile phone market. Is there a push in China as well in the retail space, clothing retail, handbags, to have national champions?
Yes, we've heard that. We've heard that everywhere. But you're still going to see, for some brands, you look at Hermes, which is still generating double-digit increases. Some brands are still that lofty. They're doing well. Another one who has a small percentage of their business in China, but it has momentum, Ralph Lauren. Ralph Lauren gets under 10% of their sales from China, but it's really mark to market at some of the upper tier, and it happens to be performing well, given that they're mainly in tier 1 cities.
You've named a couple of names. Let's talk about your top pick. What is it right now?
I'd say overall, when you look at luxury overall, Ralph Lauren is doing very well. If I had to pick from the European luxury players, the benefit in the rebound is going to come from LVMH. The breadth of their portfolio makes them differentiated from everyone else.
Say the fashion cycles feel really quick these days, maybe fueled by social media. What is the ability or even the want of some of these companies to try to keep up with them, to try to keep offering new products that capture some of the different trends?
Take a look at what some of these companies are doing. The investment by LVMH in Formula One, what happened with the Olympics, activating experiences with the purchase of discretionary goods, makes you essential and makes you in the cultural mindset.
Those are people who's doing a good job of it. Who's still behind? Who can't keep up?
I think we need Burberry to do better. You need Ferragamo to do better. They're not performing as they had been in the past, and they need to increase their relevancy.
Can we also talk about what's going on stateside when it comes to Thanksgiving and Christmas? I believe we lose 5 shopping days. How bad is that going to be for the retailers?
It is a compressed holiday season. A later Thanksgiving, 5 fewer days. Typically, you still get the majority of your sales the 10 days before Christmas. But look at starting earlier. Look at what's happening this week. Whether it's Amazon Prime Day, Target, and Walmart, everyone's offering deals. Look what's beginning to happen on websites. I do a big look every single week at what's happening. You know what happened this week? More collaborations. Levi's and Beyonce, American Eagle and Timberland. Look what Zara's doing with Stefano Pilati, the former Saint Laurent creative director. So we have ways that brands are trying to say, look at me now. Pricing was less important this past week. Differentiation was more important.
You mentioned Burberry. What do they do to get out of this hole? Because it's a real mess.
It is a real mess. You have a new CEO who just joined, Josh Schulman, who comes from the U.S., brands like Bergdorf Goodman, Capri, and also Coach, where he was before. I think they're going to go back to their heritage. One of the things that luxury brands have, they have items that are iconic. What's Burberry known for? Check and outerwear. Let's see when they do their first sales call what he has to say about his vision.
Are we back to the days where we need to hide the check on the inside of the coat? We're back to that again?
Not yet. Let's see, the new store is going to open here on 57th Street shortly. Let's see what it looks like.
Where did it go wrong? Angela Ahrendts ran this company and ran it wonderfully before she was poached by Apple. We had Beta designing things and things were okay. Where did it all go wrong?
You know, what she did in order to up the ante with Burberry, she brought social media into the equation and made it visible to all. After that, they tried to go too high-end when the brand didn't. That wasn't where the brand was. And you look at other brands that are high-end, they basically captured share. At the time when Burberry was losing, Gucci was gaining. And now Gucci has work to do too.
Can Nike be an example for these companies? The idea that if you've sort of lost your way, if you haven't gone back to basics, that you need to look on your roster of people who have left and try to bring them back?
Let's see what happens. I mean, it's going to take a while to create innovation at Nike. I think Elliot Hill is a culture builder and a people builder. I think he's going to bring in and bring back a lot of the people who had the mojo with product when Nike was there. But it takes 15 months, 18 months. You walk in the door and it doesn't change overnight.
Based on everything you're saying, what I get is that quiet luxury still reigns supreme over that loud luxury, given what like Gucci has tried in the past.
Yes, right now I think quiet luxury does reign supreme. And partly because look at all the news and noise that is out there that consumers are spending their time on. Whether it's macro events, whether it's the upcoming election, there's a lot of news and noise. So yes, quiet luxury, Hermes, Brunello Cucinelli, Goyard, they're still winning.
Don't you get the sense that that's what happened with Burberry? They started to chase the loud luxury of the Guccis of this world, and it just went wrong, like really, really wrong.
And they went too high a price for who the brand is. The consumer didn't associate them with handbags maybe that were $2,000
We saw Mulberry do
or more.
the same thing as well years ago. Why
And
have they
look what
made the
happened to
same
Mulberry.
mistake? Why have they made the same mistake?
I think sometimes you get in new designers and you feel like you have a vision and you have the authority to do it. You're going back to your archives, it matters.
So you're talking about Riccardo Tisci?
Yes.
That was his failure?
Yes. That's what it
Too
felt
much
like.
check on the outside, not enough check on the inside.
Right.
That's what I keep saying. It's got to go back on the inside. It's too loud. I don't like those kind of things. That's why they went wrong in the 80s, 90s, when the British football hooligan took over the brand. And they had to disassociate themselves with that by hiding the check. Then they chased Gucci by bringing the check back and putting it all over the place, and we are where we are.
But this is why I'm confused about LVMH. I saw they have this new croissant little keychain purse.
Right.
But are they big enough where they can experiment in both quiet and soft?
They do. I mean, they have the wherewithal. They have the design power. Look what they do in terms of activations, whether it's what Pharrell Williams did, whether it's what you had with the Olympics and now Formula One. They basically set standards, and they have a wider range than many of the super high luxury brands. Look what just happened the other week. Privately held company The Row, that's owned by the Olsen sisters, got an investment by the Chanel family, the Wertheimers. So you see where dollars are being put.
Dana, a clinic. It's good to see you.
Good to see you
Appreciate
too.
it. Thank you.
you.
We'll do it again soon. Dana Telsey there of the Telsey Advisory Group on luxury and the shortened holiday window for these luxury companies to sell some goods into. Coming up next on the programme, Greg Daco of EY and Erik Knutzen of Neuberger Berman. No doubt we'll get their thoughts on Burberry and whether the check should be on the inside, discreetly, or on the outside, loudly. They're not going to talk about that. CPI is coming up on Thursday, Federal Reserve minutes coming up on Wednesday, and bank earnings kicking off on Friday. JP Morgan and Wells Fargo get things started for you. In the equity market, about an hour away from the opening bell, equity futures on the S&P 500 just off session lows. We're down by 0.4%. Equities recovering just a little bit. In the bond market, the 2-year around 4%. The 10-year through that level. We are higher across the curve from 2s out to 30s, and crude is up by 2%, 75.85. From New York, this is Bloomberg. 60 minutes out from the opening bell. Equity futures right now on the S&P 500 down, lower by 0.4%. One headwind in the bond market, yields higher. Is good news starting to become bad news? We'll get into that. The Russell, no drama. We're down about 0.25% on the Russell 2000. With 1 hour left before the cash open, Danny's got your morning movers.
Yeah, I'm starting out with Pfizer. Starboard, the activist investor, taking a $1 billion stake in the drug company. They're trying to turn it around, according to people familiar. Exactly what they're planning, not quite clear at this moment. Shares are higher by 2.5%. The concern is post-pandemic. They don't have a big blockbuster drug like the COVID vaccine. They're not like their rivals with some sort of obesity and diabetes drug. Apparently, they are approaching former executives to try to bring them back to turn around this company. Again, kind of a Nike playbook. What's old is new. Meanwhile, Rio Tinto is making an approach for Arcadium, both the sides saying so on Monday. Those shares up 33%. It is a lithium play. It's maybe a great opportunity for them. Prices have fallen significantly given that the market is oversupplied with lithium. EV, the demand hasn't been as great with China lagging behind, but maybe the stimulus changes that. So it's an opportunity they're hoping will come to fruition. Just wrapping things up with Chevron here, another deal for the oil and energy sector. They're selling a stake in some of their oil sands and shale assets. They're going to be selling it to Canadian Natural Resources. It's just the latest big oil producer to divest a stake specifically in this area and Canadian oil sands operations. For Chevron, they're just concentrating on different things, other regions. They're in the middle of acquiring Hess John, which should help them boost their South American exposure.
Obvious tailwind for that stock this morning. Crude rally and Brent up to just short of 80 at 79.20. WTI up by 1.6%. to 75.60. Let's look ahead to the week ahead on the back of a blowout September jobs report. Markets looking for the next big catalyst. Fed minutes, CPI and PPI all on deck this week. Joining us now is Mike McKee, our economics and policy correspondent. Michael, good morning. Have you made sense of Friday yet?
No, I haven't made sense of Friday yet, and I don't think anybody has. But the question in everybody's mind is, what does it mean for the Fed? You ask, we deliver. 20 Fed appearances this week. 13 different Fed officials. And of the speeches I looked at, 9 of them seem to have to do with monetary policy. So we should get a pretty good idea of where people are. My guess is they're all going to be like Austin Goolsbee was with us on Friday and say, we don't have to make a decision yet, so we're just going to keep our options open, keep our eyes on it. But it'd be hard for any of them to say we need to cut rates 50 basis points.
Chairman Powell last week said we're not in a hurry on the FOMC. Given the data we've now seen, how important do you think that line actually is?
Well, I think that's basically the line that they will all take at this point. We're not in a hurry. If for some reason they want to go 50 basis points, they will probably have enough data between now and then. They could make a reason for it. But at this point, they don't have to do that, and they probably are much more inclined to go 25 at a time. CPI will be important on Thursday, but it won't be completely determinative. We get PCE at the end of the month, and then, of course, we get one more jobs report.
Mike, I really want to know what Mickey Bowman says at 1 p.m. Is it going to be a big I told you so?
Well, she did that last week to a certain extent, but the independent bankers, I'm not sure she's going to bring up the macro aspect of it. It's kind of hard to tell. She does a lot of banking speeches because she's the small bank representative on the Fed. And so that one might be aimed more at the bankers, but she does speak later in the week. We might get something. But,
you spoke to Austin Goolsbee on Friday. And
Yes.
he called the report superb. Did you get the sense that they're now leaning more towards really being 50-50 in terms of their dual mandate?
I think they have to be. We'll get another impression from the CPI because essentially inflation causes wages to go up. People see inflation, they ask for higher wages. It doesn't work the other way around. And so just because wages were higher this time doesn't mean we're going to get a big inflation print. So if we don't get a big inflation print, if it comes in sort of as expected, which is just a little bit of a decline, continuing that agonizing crawl towards 2%, then I don't think the Fed has to emphasize it too much, but they will say, we're focused on both sides of the mandate.
CPI coming up on Thursday. With us around the table also, Greg Daco of EY. Greg, it's good to see you.
Good to see you.
What would it take for the Fed to hit pause? What would we need to see?
Well, I certainly think we're going to hear some chatter of a potential pause in terms of Fed policy, but I don't think that's the direction of travel for Fed Chair Powell. I've talked about the fact that he has been a key influencer within the FOMC, and I think his approach is unique, having agnostic optionality, as I've described it. So essentially waiting until the very last minute and being open to potentially being surprised on the upside or on the downside and adjusting monetary policy that way. So that's what led to the 50 basis point rate cut in September. I don't think anyone knows what's going to happen in November.
I agree with you. November 7th is a lifetime away. How important is that November 1 payrolls report going to be? How important would that election be on November 5th?
Unfortunately, I think it's going to be too important. I think there's too much attention to every single data report. I know there's this notion that the Fed is data dependent, not data point dependent, but market's interpretation of how the Fed is reacting to data is very much data point dependent. And you saw it back in August, you're seeing it again today, where you're seeing these massive market reactions to payroll reports that, yes, it was very strong, but there's a reason to be cautious about the overall trajectory of the labor market. Labor demand is still cooling. The hiring rate is at a 10-year low. Hours worked are at their lowest in the post-pandemic era. So the notion that the labor market is reaccelerating somehow, I think, is misguided. We have caution on the parts of employers, and that is what is guiding the economy right now.
If we're overdoing it on just how much importance there is on each data point, how should we then approach CPI this week?
Well, I think what's important to look at is fundamentals. We have to look ahead of the curve, not just at the recent data that looks back at the last few months. We have to think about how inflation fundamentals are evolving. Is there increased pricing sensitivity on the part of consumers? Yes. Is there less pricing power on the part of businesses? Yes. Is there efforts to reduce wage growth? Yes, there's wage growth compression. So you take all of these fundamental drivers of inflationary pressures, and they're still pointing towards disinflation. Will it be bumpy? Yes, we know it's going to be bumpy. And the oil price developments right now are going to add some additional volatility. But the direction of travel of underlying core inflation is still moving in the right direction. And I think that's why you're not hearing from Fed Chair Powell any sense of panic. The economy is still evolving relatively well in terms of the inflation dynamics and the employment dynamics, and they're easing in a preemptive way to kind of rebalance the state of monetary policy.
So then that begs the question, why did they cut by 50 basis points?
I think they really felt like they were behind the curve in terms of having needed to ease back in July. And I think that makes sense. If you're looking at the level of the policy rate right now, it's quite restrictive, right? We don't know where the neutral rate is, but there is evidence in the labor market cooling, in the evolution of inflationary dynamics, that points to a fairly restrictive monetary policy stance. So you need to get back closer to neutral, given where we're seeing the labor market and inflation developments. So that's really the attempt that the Fed was trying to do. And I think that's what Powell was trying to do. He's really the key influencer within the Fed. I put a lot of emphasis on what he's thinking rather than all the other policymakers. As Mike was saying, we have a lot of Fed speeches, but it tends to be just noise.
What changed? Do you think that was a change where Chairman Powell started to take some stronger leadership over this committee? Do you think that was a shift, and what's behind it?
I think generally speaking, there were a lot of different views and a lot of data point dependency. Fed Chair Powell is not necessarily a forecaster like Bernanke or Yellen or even Greenspan. He tends to be much more focused on all of the data and is pretty much open to being quite candid as to not necessarily having a fixed view going into a meeting. He has some priors, but not as much as other policymakers. So we were talking about Berman, for instance. You have a prior that rates needs to stay higher for longer. Well, that's going to be your prior. And no matter how the data evolves, you're going to use the data to confirm your priors. Fed Chair Powell is pretty agnostic when it comes to his view on the direction of travel and monetary policy. He mentioned last week that he would see essentially 2 25 basis point rate cuts if the forecast evolved as expected. If it doesn't, if the next jobs report is very strong, he might say, well, let's take a bit more time. If, on the contrary, there is more softness, then he might say, well, actually, let's proceed with that 25 basis point rate cut. That agnostic optionality, I think, is the real driver of monetary policy today. And I think it's for the better because data point dependency has run its time.
I was going to say, Greg, you sound different than a lot of people today who are using the last months of data as an excuse to say Powell was wrong, to say he shouldn't have cut 50 basis points and maybe his leadership should be questioned. Would you push back against some of those views then?
Absolutely, because we have to be forward-looking. I mean, it doesn't matter what happened over the last month, to be honest. And we've seen revisions in the payroll reports that are about a third of any monthly print. The upward revision was 72,000. The month prior, the downward revision was 80,000. So you're seeing these massive swings in terms of the underlying data looking back. You have to have more of a forward-looking anchor. I don't say you have to forecast over the next year or 2 years. You have to forecast over the next 3 months. How are inflation fundamentals evolving? How are labor market fundamentals evolving? On both these fronts, you're seeing inflation moving closer to the target, and you're seeing labor market fundamentals pointing to easing labor demand and reduced labor supply absorption. In that environment, you have to be closer to neutral. It's not about being extremely restrictive or extremely loose. It's just about recalibrating monetary policy, to come back to that keyword.
Calm and thoughtful. Greg, appreciate it. Greg Daco there.
Always a pleasure.
Of EY. The next stop for this market is CPI on Thursday. A range of views around this table. Here's another one. Erik Knutzen of Neuberger Berman joins us now for more. Erik, you heard Greg's view on this situation. We heard from Apollo and Torsten Slok a little bit earlier this morning. Torsten's point is that maybe neutral's got a forehand, or this economy is stronger than this Federal Reserve thinks. It can tolerate higher interest rates. We heard from Ed Yardeni, who said this Federal Reserve is done for 2024. Erik, what's your view on that?
Yeah, I agree with what Greg was just commenting on. In general, the path is towards slowing growth, and the Fed has the latitude to reduce rates from here. Core CPI is in the low threes. Core PCE has a 2-handle. They're a couple percent positive real yields on the Fed policy rate. So they have the latitude to cut 50 last time. We think they cut a couple more times this year. We don't think they go to high 2s, low 3s in terms of the terminal rate. Maybe they're at 3.25, 3.5 for a terminal rate, but that's still room to go down from here. And this is in the environment of a slowing overall economy, not a recessionary economy. And by the way, China's policy announcements a couple of weeks ago helped with that kind of tail risk, but still a slowing economy, and nominal growth going from 5 to 6% to probably closer to 4% next year. That's going to have some impact on profits and earnings. That's going to have some impact on the labor market. And it's clear that Powell is focused on the labor market.
Does that mean then, Erik, that the animal spirits we saw awakened after the 50 basis point, particularly in the corporate bond market, of spreads and the high yield at 16-year lows, at an LBO machine that's reawakening on Wall Street, willing to issue debt, does that continue at pace, even in the face of stronger data that's had some question whether they can continue with the cuts that they've had?
Yeah, actually, the key question we're asking, and I think investors need to ask, is does the market trade slowing growth or rates relief? And the answer from our perspective is that certain areas of the market will trade slowing growth. And those are the areas that perhaps are the most fully valued. That's where we're concerned about certain areas of credit markets where spreads are very tight, or the most richly valued areas of the equity market, the large cap tech areas. But other areas are ripe to trade some rate relief, particularly on the front end. Those are smaller company stocks. And I agree with Bob Dahl's comments. That's not the junky Russell 2000 money losers. That's quality small and mid cap names that have been squeezed by the rate cycle. That's real estate, which has an opportunity to benefit from some rate relief. So this will be the key differentiator over the next 6 months in our view.
Erik, what are you thinking right now when it comes to the commodity market? You think it remains a useful hedge. Have you gotten in before what is happening geopolitically in the risk premium in the prices?
Yeah, we've added to gold positions in commodities. We had a small overweight in energy. Frankly, that didn't look that bright up until a week or so ago, and we view that really as a geopolitical risk hedge. Gold has been the highest conviction view within commodity markets. But in general, commodity markets, that big question is, will they trade slowing growths or rate relief? As a complex, we're closer to at target in client portfolios in commodities because of concerns about slowing growth. But we like having certain geopolitical risk hedges, including gold and a little bit of extra exposure to energy, given challenges in the Middle East.
Erik, can we just sit on gold? What are the benefits of that? We've seen a series of all-time highs. You're certainly not alone. It's not a lonely call. We've seen a big move so far this year. What are the benefits of maintaining that presence, that position through year end?
Well, it's got to do with declining the potential for declining real yields. It is, the potential for over time, some softening of the U.S. dollar as you get more kind of convergence of U.S. and other economies. And then ultimately, it is that risk hedge for uncertainty and geopolitical shocks. And that's one of the key things we're highlighting right now is that markets are, yes, the broad fundamental setup for markets is overall fairly positive and productive, but you have a lot of liquidity that's sloshing around and a lot of crowded trades. So you see, inordinate moves based on policy announcements, the 21% increase in China, the +4% and 5%, and then down 4% and 5% days in Japan around the LDP election. Gold can be a bit of an anchor to windward in that environment. And frankly, so can bonds in an environment where good news is good news, bad news is bad news. You're seeing it. Stocks and bonds are trading uncorrelated, more like the pre-COVID period than what we've seen for the last few years.
Erik, what's the catalyst for a weaker U.S. dollar, given what we're seeing around the world and this idea of U.S. exceptionalism, much better compared to Europe and China?
Yeah, look, we are actually tactically overweight the dollar right now, just given some of the decline we've seen over the last several months. But on a 12-month horizon, we think that the dollar is likely to soften, and that's based on really more of a convergence view between the U.S. economy, U.S. rates, U.S. policy, inflation, and the rest of the world. You also have, the potential for an administration that, while some of their policies may be strengthening for the dollar, really wants a weaker dollar. And we're not calling the election. We're just looking at potential scenarios and how things could play out.
Erik, does China's stimulus in kind of a Draghi style, whatever it takes moment, change that it also fuels assets outside of the U.S., not just China, but EM, maybe even Europe and their attractiveness?
In the short term, we acknowledge that the policy announcements make China more attractive now than it was, say, several weeks ago. But what we're still waiting to see is whether there is a true fiscal bazooka to try and address some of the key challenges in terms of consumer confidence and issues in the real estate market. So while the announcements help take out the short-term tail risk around a debt deflationary cycle in China, we're not ready to say that this is going to be a major catalyst for Chinese growth going forward. We'll see more in the coming days. There's going to be a speech from a senior leader tomorrow, but it's going to take several months to see how this unfolds. And then we'll be able to reassess the situation more broadly. But it certainly does take out some of the tail risk concerns around global recession and debt deflation.
Erik, appreciate it. Got to leave it there. Erik Knutzen there, Neuberger, Berman. Erik, thank you. And please, you brought up Draghi. Biggest lesson from Draghi more than a decade ago was the importance of intent. The ultimate vehicle they came up with, OMT, outright monetary transactions, are never even activated, didn't have to buy a single bond. Just showed that he was had the intent to do something. It was enough, it was sufficient. I think what you've seen from the Chinese in the last week or so is the intent to put a floor under growth and say, we'll do what it takes to ultimately hit our 5% GDP target.
That's why it's interesting to hear from people like Erik, even Ed Yardeni, kind of skeptical that the Chinese rally can continue, considering the tone we have heard from China. It's not my word saying that it's Draghi's moment. It's the Draghi whatever it takes. There's a consensus that that is what's happening in China, that they're willing to throw whatever at it. And that's why likely when the market reopens tomorrow, people are saying that it's going to be another rally reignited and maybe it helps the world. So you can kind of pick through the policy details and say, I haven't seen the bazooka yet, but the language is there.
Chinese markets reopening after a one-week holiday tomorrow. Look out for that. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Heckers. Hey, Yahara.
Hi, John. Hurricane Milton is rapidly intensifying as it heads toward Florida. The storm could reach Category 4 status and spark the largest evacuation in 7 years. Governor Ron DeSantis has declared an emergency in 51 counties and said the entire Florida peninsula on the Gulf side has potential to suffer major effects from storm surge. Milton is expected to make landfall on Wednesday. Meanwhile, Boeing will resume negotiations with its largest union today, this marking the third time the two sides have met since 33,000 workers went on strike on September 13th. The machinists have demanded a 40% pay increase and to have their pensions reinstated. Each day the strike goes on, Boeing loses about $100 million in lost sales. And LeBron James and his son Bronny made NBA history last night when they played together for the first time during a Los Angeles Lakers preseason game against Phoenix. LeBron and Bronny became the first father and son to play in any NBA game at the same time, let alone on the same team. They played just over 4 minutes side by side in the second quarter. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the week ahead. We'll get you the calendar and we'll break things down just a little bit more with Mike McKee from New York. This is Bloomberg. The opening bell about 37 minutes away. Equities recovering just a little bit. We're down by 0.4% on the S&P. Yields still at 4 on a 10-year and a 2-year this morning. In the commodity market, the rally continues. As we count you down to the opening bell, your trading diary for the week ahead, the calendar looks a little something like this. More Fed speak throughout the day from Kashgari, Bostic and Muslim. Tuesday, the trade balance. Wednesday, we'll get some Fed minutes for you. On Thursday, CPI plus another round of jobless claims and some Delta earnings. And on Friday, PPI and UMich sentiment together with big bank earnings kicking off with Wells Fargo and JP Morgan. Mike McKee back with us for more. Mike, final word, the Fed speak. How important is the Fed speak when we just heard from Greg Daco, the only voice that matters is Chairman Powell's?
I think he's right. We'll get a sense of where the committee is and whether Powell is going to be dragging people one way or another. But we'll have to hear from Powell to get a sense of where he is. And we don't have anything planned from him at the moment.
What's going to take on more importance, Fed speak or CPI or minutes?
I think minutes will matter a lot because we'll want to know what they were thinking about the trajectory going forward, as Greg was talking about. CPI will obviously be important as a data point pushing one way or another. I think Hurricane Milton could have an impact, not just on politics, but because these two hurricanes could be so big. Normally you get a rebuilding boost to GDP, but this could be spread out because it's so large, and that could affect the GDP, shopping data, everything going into November. I mean, nobody in the Asheville area is going out and buying a lot of stuff right now, and that could be true in Tampa. So you could see some impacts on the data going forward.
Also, couldn't the hurricane impact the next jobs report?
It could, certainly. It's going to. Certainly, anybody in western North Carolina, eastern Tennessee has probably not been working, at least on a regular payroll. And then we'll see what happens with with Milton and what it does, because it's going to hit right before the survey week. Survey week is next week for October payrolls.
The chairman alluded to this recently, the importance of the beige book. Is it taking on even more importance now for you?
Well, it does, because it's the only thing we get from them. They're always talking to CEOs, business people, and ordinary people in their districts and getting a sense of what is coming ahead. What do the companies see in terms of sales prospects, revenues, and hiring? And they put that into the beige book in a very truncated form, but it does give Wall Street and Fed watchers something to go on.
Whose region is this? Is it Bostic? Is it mostly Bostic where the hurricanes hit?
Mostly Bostic, but also Barkin from Richmond.
OK, so two speakers to watch potentially this week on that issue. Mike, appreciate it. Mike McKee on the latest. Big week ahead. Lots of Fed speak, lots of data. Tomorrow, here's the lineup for you. Fantastic lineup right here on Bloomberg Surveillance. We'll speak to Jack Caffrey of JP Morgan, Mohammed Al-Aaron of Queen's College, Cambridge, Tom Porcelli of PGIM, and Mark Cabana of Bank of America. And then this one, 9:30 Eastern Time. Do not miss this. Bramo sitting down for an interview with the JP Morgan Chase chairman and CEO, Jamie Dimon, just a few days before those earnings drop on Friday. Earnings from JP Morgan and Wells Fargo just around the corner. They drop on Friday morning. Before we get there, we've got some work to do. Equity futures this Monday morning, negative 1/3% on the S&P, and a brand new look in the bond market. We've got a lot of fours, a 4% 2-year yield, a 4% 10-year yield from New York City this morning. Good morning, big week ahead. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.